oftentimes not very good. And so I think just a little bit of a cooling off of the overall wage inflation, a bit of a cooling off of the stock prices, that would make me more optimistic into 2024 and beyond.
All right, Brent, well, you bring up the trade, so let's talk a little bit about that, particularly for the second half of the year here. For people who missed out on that tech rally and have clients calling them asking how they're going to reposition to get some gains in the second half of this year, what is the move? What is the reallocation that needs to happen to get some of those gains in for these next 2 quarters here?
Well, first of all, I'd caveat that I don't think anybody should be making large changes to their overall allocation. The parts of the market that we like are not tech related, and it may seem a bit odd, but I still like small and mid cap stocks for a bit longer than just the next 6 months. I think there perhaps is going to be some disruption because of that recession, but longer term, you're looking at a part of the market that trades at 13 to 14 times earnings versus over 20 for the S&P 500, or even some of those tech stocks which are much more elevated than that. I think there's kind of been a cushion there built in on that side of the equation. And I guess I'm thinking a little bit more past just the next 6 months, but that's a part of the market that I think investors need to make sure they own and not overly focus on just those tech stocks, which I think certainly there's good long-term prospects there, but I think their current prices reflect those. The other good news is the bond market. I know this isn't that sexy of a part of the market for most investors, but it yields around 5% in safer type of securities, or higher quality type of securities. And so that's where I want to make sure that people who need their money in the near term have some money within those fixed income areas, because I do think especially if we have a recession that kind of cools off inflation and kind of finally puts the nail in the coffin of inflation, I think those parts of the market are attractive also.
Where in small and mid caps do you go? What sectors?
We own more of the broad indices. I don't necessarily make sector bets or sector calls. I mean, those things are typically tilted away from those tech names and have more exposure to banks and things of that nature. And that's where I think, there may be a little bit of rocky times ahead, but I would encourage people to add on weakness to those parts of the market in the next 6 months.
And when you look at the results that we're getting this earnings season, I think about yesterday with D.R. Horton, for example, good results, but then closing lower. Can you help me understand the digestion of earnings results like that? What is the market response based off of when it comes to a name like that?
It's all about the future. So the backward earnings are the backward earnings, what companies say is going to happen in the future. And I don't know about that stock specifically, but that's where people are at right now. What does the future look like? What does the future hold? And certainly I think that's more important than what just happened in the current quarter. There certainly are things that you can infer from that. But I do think it's a forward-looking market. And I think earnings are important, but I think the macro is going to drive the overall theme, which I think it has so far this year.
I know you've mentioned in the past that international equities may be a place to be. I mean, we're looking at indices in France, in Germany up substantially. Well, I guess roughly about the same level as the S&P. So CAC 40 is up 15%, DAX up 16%. Where do you play in international equities?
We've liked European equities for a bit of over a year or two now. Part of the reason was those currencies that you mentioned. So I don't know if you're looking at returns in local currencies, but the dollar was expensive. It's weakened quite a bit, and that's been a huge tailwind to international equities, over the past year or so. And some of those countries are pretty washed out, especially after Russia invaded the Ukraine. That was an area of opportunity, and that's an area we've been overweight for some time. I come back to valuation on a lot of things, and certainly sometimes valuation takes a while to play out. But for the time period that I think most investors should be looking at, I do think international stocks offer cheaper valuations and perhaps a bit of a currency tailwind going forward as the dollar probably continues to weaken over the next few quarters. And so that's where I think they should position and just make sure they have some exposure there, because I know it hasn't worked and investors tend to kind of move out of areas they should be actually moving into.
There's got to be a yes or no, because we got to leave it here. But
okay.
China, yes, no, invest in the
We are underweight that part of the market, and so I guess it's not a all-out no, but certainly an area that we don't like as much as other areas we've talked about.
Yeah, a lot of volatility out there when it comes to everything that you could possibly base the trades off of. Brent Schutte, Chief Investment Strategist at Northwestern Mutual. Really appreciate you joining us today. Also want to mention the Russell 2000 breaking above a key level here today. This is Bloomberg. Now let's get some company news with Bloomberg's very own Steve Rappaport.
Madison, nobody likes flight delays, and a scorching stall for Delta passengers has U.S. officials demanding answers. Bloomberg's Joan Doniger reports.
Steve, the Department of Transportation wants to know why passengers on a flight from Las Vegas to Atlanta were left to fry in the fuselage as the plane sat on the tarmac at Harry Reid International Airport for several hours on Monday. According to social media posts from people on board, some passengers became ill and fainted. Others reported Delta didn't provide water to passengers and the bathrooms were closed. The airline, in a statement to ABC News, apologized to customers and said it's looking into what happened. Temperatures in Las Vegas reached 114 degrees that day. Steve?
Thanks, Joan. Delta stock is little changed this hour. The top dog in the AI chip game has competitors nipping at its heels. More from Bloomberg's Gina Cervetti.
Steve, startups are looking to capitalize on a surge in demand and a shortage of NVIDIA's new products. The Financial Times reports Samba Nova, GraphCore, and TensTorrent are among the companies developing alternatives to challenge NVIDIA's dominance. Those three have raised more than $3 billion over the years, according to data collected by Dealroom.co, which tracks private tech deals. NVIDIA is the world's most valuable semiconductor company, with its valuation crossing the $1 trillion mark in May. Steve?
Thanks, Gina. Shares of NVIDIA are down more than 1%. And Amazon plans to build a $100 million satellite processing facility in Florida as part of its quest to sell internet access from space. Amazon plans to launch more than 3,000 to make it happen. Those are the company stories we're following this hour.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone. Thanks so much for joining us here on this Friday. Seeing some green on the screen. We've got the Dow up by 0.2%. Same with the S&P. The NASDAQ still unchanged. Not a lot of volume on the day. It's a rainy Friday here, and probably going to get even more drop-off throughout the afternoon. We're going to continue to cover this all for you. But first up, we are going to get a check on the news with Nathan Hager.
May 20th of next year, Madison. Mark your calendar. That's when former President Donald Trump's trial date is set in the classified documents case. Brown University political science chair Wendy Schiller says this puts the trial right in the heart of general election season. Wendy joined us moments ago here on Bloomberg Markets.
Primary season will be essentially settled by then. You know, the primary calendar is out now with some states unsettled, New Hampshire for the Democrats, for example. But nonetheless, you know, we'll know whether Trump is likely to be the nominee by May of 2024.
And if he is the nominee, Brown's Wendy Schiller tells us it'll mean even more of a challenge for Republicans to appeal to independent voters. New York City's congestion pricing is now a federal case. New Jersey is suing the Transportation Department and the Federal Highway Administration over the plan to charge Easy Pass drivers up to $23 to drive in south of 60th. New Jersey Governor Phil Murphy hinted at this move earlier this month on Bloomberg's Balance of Power.
We can't fix a broken MTA in New York City on the back of New Jersey commuters. That's not our job.
Governor Murphy told us at the time his state was lawyering up. Supporters of congestion pricing have said it would raise $15 billion for public transit and could cut Manhattan traffic by up to 20%. He made the American songbook his own. Tony Bennett has died.
She gets too hungry for dinner at 8.
I'm starving.
He had a #1 album at the age of 88 with these Lady Gaga duets. Won the Grammy Album of the Year at 68 years old with an MTV Unplugged record. But Tony Bennett has said his career pinnacle came in his 30s when Frank Sinatra called him the best singer in the business. Tony Bennett died today. He was 96 years old. Checking the leaderboard at the British Open, round 2. It is, it's Brian Harman in the lead, 10 under par. Jordan Spieth has moved into a tie for second with Tommy Fleetwood. They're at 5 under, and at the box office scoreboard, we just learned Barbie earned $22.3 million in Thursday pre-shows at over 3,400 theaters. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg, Madison, and Simone.
All right, Nathan, thank you so much, as always, for that. And great reminder about the Barbie movie, raking it in already in the pre-shows. We're going to talk about that a little bit more later. But it's a good reminder, Simone, of the consumer strength that we're seeing out there, particularly when it comes to experiences-driven spending. You know the consumer space better than anyone here. Tell me what you are learning about the consumer when it comes to spending and resilience this earnings season so far.
Well, you're too kind. But yeah, I mean, I think that there's a bit of a divergence between what's happening with the highest end consumer and the lowest end consumer. That seems to be clear. And we expect to see this play out a little bit next week when we get some of the earnings from the consumer packaged good companies like P&G, like Kimberly-Clark, because they've been flagging that consumers are trading down in products. And then we had ConAgra's CEO talking about how, well, consumers, they might just be not buying. Now, that's not necessarily that they're not eating as much, but it is that they are conserving what they have and spending on experiences, maybe like going to the Barbie movie.
Right. That's so interesting. So is the idea that they're maybe trading down to like a Walmart for their grocery spend, saving a little money on food?
That's some of the idea that we got from retailers, but, you know, at least from the consumer packaged goods side, it's trading for the less expensive toothpaste. But, you know, the really interesting thing that everybody is watching in this space is what happens when student loan payments resume, because there are almost 27 million borrowers in forbearance now, and Oxford Economics believes that this is going to be a $100 billion a year hit to consumer spending.
Yeah, that's got to be good news for the Fed, but bad news for me personally when it comes to my online shopping addiction. We're going to continue to cover all the market moves for you coming up here on Bloomberg. More markets coverage starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone, happy Friday. I'm Madison Mills here in our Interactive Brokers studio, joined by Simone Foxman today as Paul is out at the shore on his classic Friday vacation.
Good morning, yeah.
Good morning, Simone. Thanks for joining
We're not
us.
on the weekend yet, but Paul is.
Exactly. He's at the compound, as we like to say. Having said that, we are going to continue to cover the news for you because we are in the office on this Friday, and we've got a great person to give us some news on the trade today. We've got Jess Metten in studio, the deputy team leader and equities reporter for us here at Bloomberg. Jess, thanks as always for coming in. But first, we are going to get a business flash with
John Tucker.
John Tucker.
You forgot already?
Didn't you just do one? I'm sorry. I don't know how to run this show. You just did it. What else is there to say?
Just,
what other news has happened in the past 2 minutes? That was my bad.
That was
totally
on forgot
Take it
about
away,
me.
John.
Anyway, let's clean this
I'm
up.
sure this news is going to be incredible.
The NASDAQ 100, that has been swinging between gains and losses after yesterday's 2% sell-off. Parade of earnings continues. American Express falling after missing revenue forecasts. And as we approach next week, the next Fed meeting, another quarter point percentage rate hike, that is penciled in. David Rosenberg at Rosenberg Research says it's still not all clear on the inflation front.
I would say that the primary trend is going to be towards disinflation into the next 12 months, but I would say that the next couple of months is going to challenge that view.
And right now, the S&P 500, 10 points higher. That's up 0.25% at 45.45. The Dow Jones Industrial Average, 71 points higher. That's up 0.2%. We're at 35,296. And the NASDAQ 100, right now it's in the green, 9 points higher, 15,475. Now you can bring in Jess. Sorry.
Thanks, John. No, I'm sorry. I would like to offer a sincere apology because we love to get your business flashes.
John's the best.
As she laughs.
We love your business flashes, John. All right, thank you so much. We are going to get back on track here with the news because now we can talk to Jess Metten, our deputy team leader with equities. Jess, thank you so much for coming in here. You want to start on tech since we're kind of giggling here? You want to start on some tech news? What's happening after Tesla, Netflix? What's the tech picture looking like?
The big thing is, so next week's going to be the busiest week for earnings season. And what's funny about this is you don't have all of the tech companies housed next week that are reporting when you're thinking about, we still have Apple that's going to come on August 3rd, and Amazon hasn't confirmed its earnings date just yet, but there are close to about 170 companies that are reporting next week, so that's roughly about 40% of the market cap for the S&P 500. So these are going to be companies that are obviously very tied to AI, so that's going to be Microsoft. You're also going to have Alphabet reporting, but then also we're going to have Meta, Facebook, however you want to call it, on Wednesday, which also comes after the closing bell when the Fed also conveniently has their rate decision that afternoon as well. So clearly, I mean, if you're looking at the S&P 500 on a weekly basis, even despite having that decline yesterday, still higher for the week. You're also looking at the NASDAQ 100 did post its biggest loss, more than 2% yesterday, biggest loss since February, but it's still down only about 0.5% on the week. So showing you some resiliency more broadly, despite after getting those earnings from Netflix, as well as Tesla this week. But also those stocks have been on such a tear, and especially Netflix over the past 12 months, up more than 100%, looking at that ticker symbol TSLA, and then also Netflix, ticker symbol NFLX. So obviously when you have such a big run like that, not surprising to some investors seeing a little bit of a pullback, but looking at sort of how also the trajectory, we know that the Fed is most likely close to being done when it comes to the interest rate increases, but When you think about tech and growth stocks, obviously high duration, really tied to future profit growth, what Fed Chair Jerome Powell could actually signal during that press conference, because this meeting does not come with economic projections or the dot plots. Those are quarterly, so we won't get those until the September meeting. That decision's on September 20th. But there's going to be a ton of inflation data between this next Fed decision and the one in September. So next Friday, we have the employment cost index. That's quarterly. That's something that Powell, as well as other Fed policymakers, watch very closely. We also have the PCE indicator. That's the Fed's preferred gauge for inflation next Friday. So most likely Powell will probably signal data dependent as well. But then we still have a couple more CPI prints, PPI, as well as PCE before that September meeting. So clearly how that ties into the trajectory, and then also what that means for these big growth stocks that obviously are trading at pretty lofty valuations.
Yeah, well, we may be lost without those dot plots. I mean, talk to me about the mood going into this tech earnings week, because we're looking at NASDAQ 100 index up more than 40% since the start of the year. Is there more optimism to go?
Well, part of this isn't just because of AI. I know that a lot of that is hinged on it when you think about the names like NVIDIA, but a lot of these companies had bounced back at the beginning of this year because of improving margins. Think about the cost-cutting efforts, like say a stock like Meta has been well over 100%, close to 200% since that first tranche of job cuts last November, and also other particular groups in that sector. So it's not just an AI story, it's a margin story. So those cost-cutting efforts also, as well as some of the big layoffs that we've seen. Apple was not among those other big tech companies because it didn't go through an aggressive hiring phase as much as some of its counterparts in the pandemic. So that's why it's been a bit more resilient. But not just an AI story, it's really about margins. And so when you're looking at the top 5 companies for the S&P 500, if you're looking at, say, Apple, Microsoft, Amazon, NVIDIA, Alphabet, they're actually supposed to post a 16% gain year over year in their profits. And that compares to a 9% contraction in the broader S&P 500. So if you do see these companies come in better than expected, even though they are trading at these lofty valuations, there are analysts that are suggesting that it can actually move further from here if they can deliver. It's just the question that AI trying to gauge also what that means for a company is very tricky. So they're going to have to deliver on that. But also, if you do see a pullback, wouldn't be surprising after the best first half to a year ever for the NASDAQ 100.
Well, it's interesting that you bring up the cost-cutting measures and the impact that's having on margins. It makes me wonder whether this earnings season is like the last gasp for air when it comes to earnings, or can traders anticipate another round of good earnings news heading into the next quarter as well?
Well, the S&P 500, when you exclude the energy sector, because that's actually masking the strength in other industries. The opposite was true last year because it was masking some of the weakness. So because energy not performing and the outlook not quite as strong because inflation has been improving, and then obviously commodity prices have come down. If you look at particular industries that are tied to the consumer, especially the health of the economy, looking at discretionary, but then also industrials, analysts are actually marking those up on a 12-month EPS forward basis, more so than others. And tech is about to turn positive as well when you're looking at that. So that tells you when you're excluding energy from the S&P 500 and the earnings outlook, the S&P 500 would be back to growth in the third quarter, back to double-digit growth at the beginning of next year. And if you look at how that correlates to what the S&P 500 has done this year, you can see where that bottomed out. So actually the worst of the margin pain may already be past.
Well, talk to me. You mentioned the consumer there. American Express earnings out today, missing estimates, card spending growth slowing. Talk to me more about this, because shares are down now 3.7%.
Yeah, so this is ticker symbol AXP falling. So it did, when you are looking at its revenue, it did miss estimates, and a lot of that was tied to how card spending and growth of that is cooling. And when you want to think about a company like that, to your point, Simone, obviously very tied to the consumer and what that could mean. So second quarter revenue rose less than analysts were expecting. And also, if you want to look at what's happening with volume, it's on Amex's network. It actually increased about 8%, but the problem with that was it was the weakest gain since the first quarter of 2021, and smaller than expected than analysts were actually anticipating. And then revenue also fell short of estimates. So clearly when you're looking at that and those companies that are tied to the consumer and these credit card issuers, what that means moving forward, and also how investors and also consumers clearly shifting their spending, that's going to be a key gauge when you look at some of Amex's rivals coming up in their earnings report. And if they are seeing indeed the same type of pattern there and a shift there.
Well, we've only got about a minute left with you here, Jess, but I do want to get your take on the NASDAQ rebalance. What do we need to know heading into next week about the impact that could have?
So NASDAQ has been a bit coy on what exactly and specifically is going to happen. The problem is when you're looking at the top stocks, they had composed about 55% of the market cap of the index, and they're trying to bring it down to close to about 44%. Some of the questions are about whether Meta will be included or not, because it's the percentage and the weighting in that is just right below the threshold, so there's some debate there. But this is actually going through before trading on Monday, so there's a lot of this we still don't know just yet, and that's what's making it very tricky for investors to try to trade this ahead of next week.
Yeah, it's going to be a crazy afternoon. Who knows, I guess. Right now, I mean, the NASDAQ 100 not doing that much, so.
Yeah, we'll be asking you a lot more questions on that, Jess, coming up next week. Thank you so much for joining us. That was Jess Metten, one of our leaders here at Bloomberg on the equity side of things. John, do you want to do any more news here, or are we good to continue?
No, I think Jess pretty much covered it. She did an awesome job. So I'm just going to sort of go away, join Paul at the beach.
All right, well, that sounds good. I'll miss you guys. Thanks for the
Maybe go
invite.
to the American Mall, and where is it now? East Rutherford?
I think we're not
American
doing
Dream
in-person mall shopping anymore, John. That phase is over.
But you got to go to the American Dream
High-end
Mall.
malls alive.
Is that Joe Mysak's favorite place to go?
Okay, well, thank you so much for teeing up my favorite part of the week. Every single week. This is the joy of my career. I am honored to have Joe Mysak here in studio to talk about municipal bonds with us. I do want to mention that this is our Focus on Munis. It's brought to you by Build America Mutual. The New Deal created American infrastructure that unleashed new opportunity. Not yet, I'll point to you. Today we're doing it again with massive investment in modernizing our infrastructure and municipal bonds backed by Build America Mutual. Help make it happen. Invest in the future of America with BAM insured bonds. All right, that is our billboard here. Joe, thank you so much for being here with us yet again.
Tucker was not using a full wind up there.
I know. I was a little disappointed by that BAM, but it's fine. It's fine. You can work on it for next week.
All right.
Joe, what's going on?
Oh, man, this week, tons of news in Muni land. I know it's July, but there is tons of news. We had the VRDO trial, and we've had a build-up in the crazy nutty bond calendar, and just, New Jersey news, MTA, things are going crazy.
Let's talk. Can we talk about
inflows?
Can we talk about some of these bonds building up in the system? So you have a great story out how municipal project finance bonds are now struggling to find buyers. Does this mean that those projects aren't getting funded and aren't moving ahead, or what happens here exactly?
Oh yeah, no, they a lot of those deals have been on the calendar for months, and so you're not going to see some recyclers or some, the weird things that are, people want to build out there, crazy recyclers. Although a steel recycler did get priced this week. I was working on this column and I said, wow, it's $1 billion in kind of either 144A deals, which, are kind of private placements to limited investors, or just outright junk-rated stuff, was building up on the calendar day to day. And I saw this one actually priced.
Incredible.
12's at par.
Go ahead, Simone.
What are the analysts you cite? A senior portfolio manager at Allspring Global Investments, Nicholas Venditti, and I'm sorry, Nick. But he talks about a real bifurcation in high yield, where you have some of this being venture capital versus actual traditional muni bonds. What do investors actually like, and what don't they like? Do they like the VC stuff? Do they like the basic, boring old stuff?
Well, most of your municipal bond investors like good old municipal bonds, and I like stuff, and Nick Venditti brought this up to me. They like stuff that if you look at it and say, wow, okay, I can see that that's a municipal bond. It feels like a municipal bond, as opposed to, a bond for a recycler of almost any nature, which does not look to me like a municipal bond. It's a corporate bond, really, because you're depending upon a company and with a very speculative, dream-like project, if you will.
I don't know,
And so,
recycling seems
investors
straightforward.
kind of shy away from that. Your general kind of investor, you really have to go out there searching. And so you could see with that build-up in the calendar, companies are having a tougher time, and they've had to kind of negotiate with a lot of these buyers, and the big buyers just don't want to, get involved. And you'd think that in a year like this, the funny thing is, in a year like this, when we've had municipal bond supply down almost 20%,
right?
You would think that issuers could name their terms. No, we're not going to have any reserve funds anymore. We're not going to have, this early call. We're not going to have this. No, in fact, you have buyers now who are playing tough and saying, no, you got to add more here. You've got to add more here. You've got to add more here.
Yeah, well, we joke around a lot, Joe, but what I think is so cool about what you cover is that it relates to so much of what's going on in the world when it comes to everything from transportation here in New York City to the moves of the Supreme Court. So I do want to talk to you about the surge in donations to HBCUs, historically black colleges and universities. How is that going to play out in the bond market in our final minutes?
Oh, together? Wow. These the historically black colleges and universities have been gaining students, gaining enrollment. Yeah. And, enrollment, nationally is down, I think, 7%. But, what's happening when you have more and more applications, enrollment going up, we're seeing upgrades. Bond upgrades for these colleges, which not too long ago we were writing stories saying, wow, these guys are paying so much more on the bond market because they have low credit ratings. Now you're seeing those credit ratings go up and the borrowing costs go down.
Well, and all of this, of course, comes after the Supreme Court's ruling.
Right. They're going to see more. They are going to see more, even higher enrollment.
Right.
So this is something that's, this has been going on for, I want to say, 2 years, 3 years, basically. Yeah. And, this is just going to, we had a quote last week where someone said, people want to go to school where they're appreciated.
Yeah, and it looks like undergraduate enrollment at HBCUs is already growing, grew 2.5% this fall.
Yeah.
Right.
6.6% increase in first-year students. So we're already seeing it, as you say.
Yep.
Yeah, and the rollback of affirmative action is only going to continue that. Joe.
That's it?
That's it.
Oh, no.
I know. It breaks my heart every time, like a knife in the chest, to say goodbye to you. Thank you so much, Joe Mizak, for bringing us our Munis in focus and the highlight of my week. Seeing a little bit more green on the screen, S&P, Dow Jones, and NASDAQ now in the green. This is Bloomberg. Let's get some company news now with Bloomberg's own Steve Rappaport.
Hello. The head of the UK's antitrust regulator says the ball is in Microsoft's court now to show that its merger with Activision Blizzard won't stifle the video game market. Competition and Markets Authority CEO Sarah Cardell tells Bloomberg Surveillance.
At the moment, our decision on prohibition stands. We investigated very thoroughly the deal. We found that there were serious concerns in relation to cloud gaming, and the proposals that were put forward by Microsoft at the time did not resolve our competition concerns. So Microsoft have indicated that they are considering how they might restructure the deal in a way that resolves our concerns.
Cardell suggested divestment as a possible solution. Shares of Microsoft and Activision Blizzard little changed this hour. A natural disaster could prove disastrous for the nation's drug supply chain. Bloomberg's Jeff Bellinger reports.
Steve, hospital drug buyers are scrambling to figure out how tornado damage at a Pfizer plant in North Carolina will affect the availability of medicines nationwide during record-high drug shortages. Healthcare service providers Premier and Vizient say they are turning to other drug companies to see who can ramp up production. Hundreds of medicines, including cancer drugs and antibiotics, were already in short supply before the tornado hit.
Thanks, Jeff. Pfizer shares are up 1.25%. Bankrupt crypto exchange FTX is suing founder Sam Bankman-Fried and his top associates in an effort to recoup more than $1 billion in questionable deals. Bankruptcy rules allow FTX to recover payments made before the firm filed Chapter 11. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The Dow Jones Industrial Average looks like it's aiming to stretch its winning streak to 10 sessions. Technology stocks, they're trying to rebound from the sell-off we saw yesterday after, what is that down there? Disappointing earnings. It's like all sorts of
What is going on in the studio today? Sorry,
it's
Friday.
It's
Continue.
Friday. Freaky Friday. American Express falling after the company said revenue was less than expected. And then you have shares of the oil services company Schlumberger after second quarter revenue. It is falling at the oil field services company. That came in below expectations. In the NASDAQ 100 right now, Broadcom, Texas Instruments, and Apple helping lift the index, again, after yesterday's 2% sell-off. Among the most active, Tesla shares down 0.5%. And look at Sirius XM Holding, almost 12% lower right now after an analyst downgrade. S&P 500, 15 points higher. That is up 0.4%. We're at 4550. The Dow Jones Industrial Average, 81 points higher. That's up 0.2% at 35,306. And the NASDAQ 100 right now, 40 points higher, up 0.25%. We're at 15,506. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Simone and Maddie.
John, thank you very much for that.
You're very welcome.
We always appreciate the update. I mean, we're looking at a bit of green on the screen. It seems to be accelerating across our U.S. markets. Dow Jones now up 0.2%. S&P 500 up 3.5%. So maybe a little bit of enthusiasm here as we continue on in this Friday. And to break everything down for us, we bring in Adam Coons. He's portfolio manager at Winthrop Capital Management. He is responsible for research in tech, telecom, and industrial, but also does fixed income, equity portfolio strategies. Adam, thanks so much for joining us. I mean, we've been following really closely some of these tech moves with the NASDAQ 100, its biggest drop in 5 months. Where do you see things going from here? Is this just a little bit of the end of the momentum?
Yeah, first off, thanks for having me. To reiterate that, I think we saw, the first half of the year was really driven by that FOMO trade, where investors were reversing the declines that they experienced last year started to chase stocks again, and you see that with names like Carvana that are up over 1,000%, and really nothing from a valuation or earnings have really changed. So the artificial intelligence narrative obviously was a big push for that. And I think what we saw was that valuations really just got out of line. So we're not surprised to see a pullback here. We think that will continue as long as valuations are stretched and are really narrative-based moves in stocks. We think investors are wise to fade that trade.
Yeah, it's really interesting that you bring up Carvana, because the story just crossed on the terminal about AutoNation and Carvana seeing prices falling as that margin pressure continues to grow. Adam, I'm so curious whether this earnings cycle that we're in right now is going to be looked back on as a final gasp for air for markets and in terms of consumer spending. Do you think that this is the last of the good news we're going to see when it comes to the margins picture for this earnings season?
We absolutely do. And a big driver of that is that this forgotten fact behind inflation. And so I think a lot of investors have forgotten the fact that top line growth was largely driven by the high inflation numbers. That translates obviously into higher price of sales. As we start to see disinflation or inflation slowing, ultimately that is going to reduce the potential growth of the top line. And so we think that's going to be the further driver of this earnings recession that we see happening in the back half of 23 heading into 2024. So yes, to reiterate your point, we do see this as kind of the peak, the last hurrah for equities right now.
We were mentioning earlier and talking about this, how the revival of student loan payments, the return of student loan payments, Oxford Economics estimates that it may cost consumer spending more than $100 billion a year. How much do you see this as a factor? I mean, were consumers really expecting never to have to kind of pay student loans again?
I think some were. I mean, I think there's some that will be prepared for it, but there will be a cohort that is not. And unfortunately, those will probably be the ones that don't have anything in savings either. So ultimately, this will begin to cause stress in the market and the economy. We don't see it as a significant stressor, but right now there are a lot of things kind of coming together that this is just one more layer of that. Like I said, you've got the CRE issue coming up, and so when you start to there's these fragmented things that seem very unrelated, but if they start to happen all at the same time, they will have a larger effect on the economy. And then once again, that's kind of playing into our thesis on the back half of this year heading into 24.
Yeah, well, it's so interesting because there's so many conflicting factors happening in this economy and in this market. You've got the return of student loan payments that's going to weigh on consumer spending. Then you've also got a stronger job market than ever, wages continuing to rise. Adam, when you look at the totality of all of the factors impacting our macro environment right now, how are you making sense of it?
Well, we're really focused on, what are lagging versus leading indicators. And you just hit on employment. There has been a lot of focus on employment, and it's obviously important. But everyone that's, knows macroeconomics understands that employment is the biggest lagging indicator. So while we're going to watch it, and we know that it will roll over at some point in time, it is not the indicator that we're really focused on when things start to shift. It's really based around the consumer, their confidence, what levers they have to pull. So as we continue to see savings rates fall, when we see consumer confidence at lows, and when we see credit card usage at all-time highs, those are all things that point to leading factors that will stress the economy. Ultimately, that would then lead to employment rolling over. But that's really how we're deciphering between the discrepancies in the macro data is what's pushing the economy versus what's just kind of pulling along.
Well, we do get a bunch of consumer-related earnings next week, but in the past week plus or so, we've heard from a lot of the major banks, most recently the regional banks, and then, of course, American Express, sort of financial services today. What's your takeaway from what we've heard from executives over the past couple of days?
Well, I think, there's always this need to try to create a positive spin, but I think when we look at overall habits, and like I said, how much more spending capacity there is, I think that feeds into the narrative that the consumer doesn't really have much more room to go here. So I think that's kind of what we're hearing right now from the banks and their lending perspective. And then I think we'll get that reiterated next week from the actual consumer companies themselves.
Yeah, and you cover tech and telecom specifically. I wonder how you are digesting the miss when it comes to Tesla and Netflix this week. Is that a bellwether for the rest of tech earnings, or is that kind of a siloed, idiosyncratic earnings print?
We see those as siloed prints. We're really focused right now in kind of the more safety cash flow names within tech. There's a time and a place for your Teslas and your Netflix. That was early in the year when you were kind of riding momentum train. Right now, like I said, we're fading that trade, and we're really focused on the somewhat boring names. Your Microsoft, your Apples, your Alphabets. We think if you're going to be in tech, you want to stay safe right now. Do not chase. Especially do not chase, narratives or, earnings that really have no basis from a fundamental standpoint.
I know you cover telecoms as well. I just want to get your take. There was that news out from the Wall Street Journal over a week ago now about sort of lead pipes being that were in all these telecoms networks. I mean, do you stay out of telecoms just until this kind of fades?
I think you do. Unfortunately, I think this is a story that's going to play out for a while, and it ultimately will lead to higher cost, and which is already an issue for telecom. So I think right now there's just not a story behind any of the names worth getting behind, whether it's earnings, top line, margins. It's just all a headwind. So yeah, we would stay away right now.
And how much of a defense play are you seeing when it comes to the industrial space? And can you help us with any sort of names or broad themes on where you're seeing the most defensive moves when it comes to industrials?
Yeah, so I mean, I think obviously defense and aerospace has been the laggard with industrials this year. So in our minds, we see that shifting in the back half of the year. We see more value-oriented investors moving into industrials as that safety play. So we're moving into overweight, and we are seeing more investors taking that stance on aerospace and defense as the way to play the back half of the year, 2024, as we start to see the cycle shift. So Lockheed Martin is a great example. We just see the overall spend continue to increase there. Like I said, that overshot a little bit in 2022 with some of the conflicts in Russia and Ukraine. So we thought it got overbought, but now it has cheapened up, and so we do like the sector, and like specifically Lockheed Martin here in the back half of this year.
This has got to be like a one-word answer here, but what is the data point you are watching next week of them all? Data point to rule them all.
That's a tough one. I don't have a good answer. I apologize.
It's a full week of data. We've got
It is a full
GDP,
week.
we've got housing starts, we've got consumer comp.
I think for me, it's probably consumer confidence. I think that's going to really be the driver of everything in the future.
Adam.
Yep.
Yeah, appreciate it. Got to leave it there. Thanks, Adam, for your look at the markets. Adam Coons, portfolio manager at Winthrop Capital Management. Now let's get to Washington and get world and national news with Nathan Hager. Nathan.
Simone, the trial date is set for former President Donald Trump's classified documents case. U.S. District Judge Aileen Cannon scheduled it for May 20th of next year. This rejects the Justice Department. It wanted December. Trump's team, they were hoping for a delay until after the election. Brown University political science chair Wendy Schiller says this date will have a political impact.
If the nominee is decided, we think it's probably going to be Biden, and we think it may be Trump, then the American public's attention is on this trial. And so it will galvanize Trump supporters, but it might also continue to give independent voters, who are absolutely crucial in 2024, more pause.
Brown's Wendy Schiller joined us earlier on Bloomberg Radio. Another legal issue for former President Trump is about to end in a settlement. The New York Times reports Michael Cohen is preparing to drop his lawsuit against the Trump Organization over more than $1 million in legal fees he's been fighting for since 2019. Terms of the deal are likely to remain confidential. Cohen is still set to be the star witness in the Manhattan hush money case against the former president. A double political blow for UK Prime Minister Rishi Sunak. His Conservative Party lost 2 key elections in 2 corners of England. Bloomberg's Lizzie Burden has more from London.
The Tories actually clung on to Uxbridge, which of course is Boris Johnson, the former Prime Minister, seat in northwest London. What might have happened there is it might have been more to do with this row over car emissions that's particular to that constituency.
Bloomberg's Lizzie Burden reports this puts the opposition Labour Party in a strong position ahead of the next national election, which just so happens to be coming up right around the same time as the one in the U.S., November 24. At the British Open, Brian Harman is atop the leaderboard 10 under. It is a three-way tie now for second. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And right now, the major averages are all higher. I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The parade of earnings that marches on. American Express shares dropping after the company reported revenue for the second quarter that missed estimates. And then you have CSX shares. They're falling. The rail freight company reported a revenue that undershot estimates. SiriusXM plunging. At least 4 analysts downgrading their rating on the stock. Meantime, Sarah Hunt, the chief market strategist at Alpine Saxon Wood, says the Fed and earnings in the driver's seat for equities going forward.
I think the question going forward is, yes, you have a Fed now that is going to be looking at, we still have a very strong labor market, so the odds of them doing something in July are almost 100% at this point. And the question really is going to be, can companies continue to adapt and adjust and continue to keep their earnings?
Right now, the S&P 500, 16 points higher. That's up 0.4%, 4550 on the index. The Dow Jones Industrial Average, 97 points higher. That is up 0.3%. The Nasdaq 100 up 27 points, a rise of 0.2% after yesterday's 2% sell-off. And Warner Brothers says Barbie took in a strong $22.3 million in ticket sales from the early screenings in theaters. The film officially opens, it sounds like a commercial, officially opens at a theater near you today.
Thanks, John.
The Tuck will not be watching that one.
Oh, the Tuck, come on. Yeah, you're an Oppenheimer guy. It's written all over you.
There's a term, I guess it's the Barbie Oppenheimer for the people who
Well, you can do both. Why not?
Why
Double
not?
feature.
Why
Barbieheimer.
not? Well, on that exciting note, let's turn back a little bit to the earnings picture because we did have Blackstone earnings coming out yesterday. We had BlackRock earnings about a week before, and we want to get the latest on this with Kathy Seifert. She's the director of research at CFRA. She has a buy rating on both of these names. Kathy, let's start with Blackstone. The picture kind of mixed here. What was your takeaway?
The picture was mixed, but I think we're starting to see signs, encouraging signs. I mean, granted, coming out of the pandemic, most of these companies in the asset management space are going to have some tough comps after a strong post-pandemic recovery. But in the case of Blackstone, I mean, the shares are up over 40% this year because they weakened late in 2022 on news that the company was starting to put a ban on redemptions in their real estate space. So, I mean, there's a lot of moving parts here, but I think bottom line, I think the stock is poised to outperform, largely because there's still a positive secular growth story here in the demand for private credit, private equity assets, assets that are not correlated to the broader market. I think the thing that we need to see, and it'll help a lot of other companies in this sector, is the capital markets activity to improve so that private equity firms can increase realizations, which would help their top line. And that'll also help the iBanks as well.
Do you think private credit is still the big winner for these asset managers?
There is still, I also follow the insurance companies, so I sort of see the demand curve for this, and there is still a fair amount of demand for private credit. I think one of the trends to be looking for is kind of the democratization of these products as private equity firms seek to build out a suite of products aimed at not just the ultra high net worth, but high net worth individuals. So I think that to a degree will also help fuel some of the demand. Insurance companies are still increasing their allocation to private credit. So yeah, I do think that the demand curve there is still fairly attractive.
Yeah, one of the things overall, I mean, maybe this demand for private credit continues, but Blackstone generally finding it hard to raise new funds. They raised $17 billion in the second quarter. That was down 77% on a year-on-year basis. Maybe that wasn't unexpected, but why are they finding it so challenging to raise these funds right now?
Well, I mean, this is also coming off, as I said, a really strong fundraising year after the pandemic. So there are tough comparables there. And I think, I think the environment, given the velocity of interest rate changes, brought on by the Fed, I think it was difficult for a number of firms to make commitments. So my sense is that things will pick up once the interest rate environment, settles down a little. I think it's also important to remember that if you look across the asset management space, private equity firms and the likes of BlackRock continue to grow organically, i.e., they continue to bring in new business. There are a lot of asset management firms that don't, and they're bleeding assets. So I think it's also important that, yes, while it's down from a really strong, couple of years previously, it still represents organic growth, which is significant, because once you get some market performance, you get dual catalysts of organic growth and the tailwind of asset appreciation.
Well, one of the headwinds is the slowdown in deal making, as you know, Microsoft Activision notwithstanding there. How big of a headwind is the challenging deal-making market that we're currently in right now for these firms?
Well, I mean, not to make a plumbing analogy, but it's kind of like the pipeline is sort of backed up a little bit. And, if you look at sort of the fund inflows and outflows in private equity, at some point, you need to start realizing some profits on these assets, particularly as, some of these funds have set, targeted expiration dates. It's difficult if you're not realizing gains on those assets. I mean, what we're seeing in a lot of the private equity firms is they are deploying capital. And I think at some point, and John Gray talked about this on the Blackstone call, that as the year progresses, the capital markets activity should pick up, and that should help the pipeline, which ultimately helps the top line at private equity firms like Blackstone.
Kathy, talk to me a little bit about BlackRock. It seems like flows into their long-term products widely missed analyst expectations. I mean, is this the same flavor of issue that we were seeing at Blackstone?
To a degree, yes. I mean, I still, the fact that they continue to have organic growth that's sort of at the top of the heap for traditional asset managers, that's key. The fact that they have Aladdin, their technology business, that's key. Although, quite frankly, Silicon Valley Bank was reported to be an Aladdin client, so that was a little bit of a black eye. We didn't hear anything about that on the call. But again, it's a function of some tough comparables coming out of the pandemic. I also see BlackRock at a little bit of an inflection point. They dominate in ETFs. They have a strong fixed income franchise. Where they don't have a big presence is in alternatives, private credit, things like that. And so I see them gradually building out that business, likely through acquisitions, although I don't see them making blockbuster deals. I see sort of a bunch of sort of smaller incremental deals. I do still like the franchise, though.
Yeah, I mean, one of the questions has been what happens when Larry Fink kind of steps back. We only have about a minute here. Give me your thoughts. How close are we to even getting a name of a successor?
This is the game that we play with Berkshire Hathaway. I follow Berkshire Hathaway, and this is the game everyone likes to play. Bottom line, I think the bench at BlackRock is deep enough that investors do not need to worry about the future of BlackRock after Larry Fink.
Very interesting. He's such a personality, that said, BlackRock's a big organization, and folks, we look at Blackstone, has been able to move on, have been able to establish a new top dog, even after founder Steve Schwarzman steps away a little bit.
Right. Yeah, it's really interesting to continue to monitor kind of these big name guys on Wall Street that continue to just have such a huge impact on the overall market and sentiment. Traders really hanging on to every word that they say, especially given just the volatility and confusing nature of the market that we are currently in, Simone.
Yeah, absolutely. And we are still looking at some green on the screen today. As this Friday nears the end of the week, plenty to watch here. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport.
The FTC puts the brakes on its in-house trial against Microsoft's $69 billion takeover of Activision Blizzard. More on that from Bloomberg's Sarah Forden.
Entirely, they could reschedule it, but at the moment, this will open the door to talks with Microsoft, which is now going to be able to come into the FTC and make any kind of settlement proposals that they might want to make to try to get the FTC to bless this deal.
Thanks, Sarah. The companies extended their merger deadline by 3 months as they attempt to win over UK's antitrust regulator. Shares of Microsoft and Activision currently both in red territory. A movie theater chain's experiment to charge more for some seats gets 2 thumbs down from customers. Bloomberg's Gina Cervetti reports.
Moviegoers were not really interested in paying more for what the theater said were better seats. Now AMC is giving up on the pricing scheme called Sightline. A trial run showed that unlike sporting events or concerts, moviegoers were not willing to pay more for seats in the middle of the theater, for example. AMC says that instead it will try out a new type of spacious front row seat that reclines.
Thanks, Gina. Shares of AMC currently up more than 2.75%. Tesla shares took a big hit early this morning after yesterday's skid that took a $20 billion chunk out of Elon Musk's fortune. His drop in net worth to $234.4 billion is the 7th largest decline ever among those in the Bloomberg Billionaires Index. Musk, however, does remain the world's wealthiest person, exceeding Bernard Arnault. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone, happy Friday. I'm Madison Mills here with Simone Foxman covering all the market news for you today. Seeing some more green on the screen here. We've got the Dow Jones up a little over 0.2%, the S&P nearing 0.3% in the green, and the NASDAQ getting into the green today, but still seeing a lot of volatility bopping around with the NASDAQ heading into that rebalancing and some volatility for them throughout the week as well. Having said that, we're going to continue to cover some of the news for you here. We're going to get a check on some company news with our very own Steve Rappaport. Just kidding. It's world and national news with Nathan Hager.
Either way, I'll throw some company. No, I'm not going to throw in any companies. Good morning. The date is set for former President Donald Trump's classified documents case. That's our top story this late morning. U.S. District Judge Aileen Cannon scheduled the case for May 20th of next year. That's nearly 6 months before the presidential election. It is a setback for the former president. His lawyers had asked for that trial to be delayed until after the election as he faces other criminal probes and an election campaign. But the Justice Department had wanted this trial to start much sooner, by this December. Of course, the former president is facing 37 federal counts tied to his handling of secret documents at Mar-a-Lago. New Jersey is suing over New York City's congestion pricing plan. The proposal would charge Easy Pass drivers up to $23 to drive into the city south of 60th Street. But New Jersey Governor Phil Murphy has said the plan would fall hardest on his residents.
This discriminates against New Jersey commuters. It's a huge tax on them. It frankly challenges our environment.
And that was Governor Murphy earlier this month when he told Bloomberg's Balance of Power his state was lawyering up against congestion pricing. The case filed today names the U.S. Transportation Department and Federal Highway Administration as defendants. Texas A&M University says its president is resigning immediately following the hiring of a black journalist that unraveled over pushback against her diversity and inclusion work. Catherine Banks' resignation letter says negative press has become a distraction at the College Station campus. The A&M system says Banks took responsibility for a flawed hiring process for former New York Times editor Kathleen McElroy. Tributes are pouring in for Tony Bennett.
I left my heart.
Elton John calls him irreplaceable. He posted that on Instagram. Stevie Van Zandt writes on Twitter that Tony Bennett's heart was as big as his voice, and the Reverend Jesse Jackson noted his dedication to doing good. Tony Bennett died today. He was just 2 weeks away from his 97th birthday. Checking the leaderboard at the British Open, it is round 2 at the Royal Liverpool Golf Club. Brian Harman remains the leader at 10 under par. Antoine Rosner has moved into second at 5 under. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Simone and Madison.
Nathan, thank you very much. That's Nathan Hager. Netflix sent the market a bit. It's had a terrible couple of days. It was down 8.4% yesterday, down more than 2.6% in trading today after some disappointing earnings. But Maddie, I know that you're looking at some interesting analysis on this, right?
Yeah, well, it's really interesting to look at how these streaming giants are going to compete with social media platforms. Think YouTube, think TikTok, taking a lot of the eyeballs away from a streamer like Netflix. And we've got a great report from Bloomberg Intelligence showing that mobile app revenue for digital ad companies shows that social media platforms like a YouTube are getting a lot more revenue in from advertisements specifically on user-generated content than a platform like a Netflix, which is still barely getting a dent when it comes to ad contributions to their overall revenue. And as you know, Simone, they added this.
Cutting exactly what you're saying, eliminating that lowest, that cheapest non-ad tier. Clearly they're expecting a fair bit of revenue to come in here from that, but Bloomberg Intelligence maybe has a little bit of a dubiousness about that.
Yeah, a little bit of dubiousness. I mean, I see it all the time. People are spending a lot more time on TikTok, particularly younger folks, as we say, than they are watching content on streaming platforms. We'll continue to cover all of this for you here. More markets coverage starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
I'm Madison Mills here in our Interactive Brokers studio with Simone Foxman covering the news of the trade today. We're seeing tech stocks pairing that rebound just a bit on this Friday afternoon here. Treasuries rising just a bit, and the NASDAQ still next to unchanged today, but dipping into the green a little bit following some of that volatility earlier this morning. We're going to continue to cover all the market news for you, but first, let's get a business flash with Charlie Pellet.
Much, and here's what's going on. We've got the Dow, the S&P, NASDAQ all in the green, and yes, soft session highs, but still looking at a 13-point jump as we wrap up the trading week for the S&P 500 index, up today by 0.3%. Middle of the summer, year to date, we have got the S&P up by 18.4%, but look at NASDAQ in the year-to-date column on the Bloomberg, up 34.5%. Today, we've got NASDAQ at 14,086, higher by 23 points. The Dow up 80 points, a gain of 0.2%. The Dow, by the way, on the year up by 6.5%. A broadening of the rally, a lot of people looking for that, with the Russell 2000 up today by 2 points, a gain of 0.1%. 10-year yield 3.82%, with a 2-year that's yielding 4.86%. Spot gold at $19.60 the ounce, down by about 0.5%. And West Texas Intermediate crude up 1.2%, $76.54 a barrel. Bitcoin still below $30,000, $29,867 on Bitcoin. For Bitcoin, that is a gain today in advance of just about 0.4%. So, what about the overall market backdrop? Brent Schutte is Chief Investment Strategist at Northwestern Mutual, and he was a guest right here on Bloomberg Markets.
The Fed doesn't want a wage price spiral a la 1966 to 1982. And so they're fearful that if wages keep rising where they're at right now, that will pull that current inflation back up. And so unfortunately, I don't think we're going to get out of this kind of time period coming up without a recession, which I think will put a damper on stocks.
And of course, you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Of course, also central banks front and center next week with that Fed decision. Again, recapping here, we have got the 10-year yielding 3.82%. Briefly, AutoNation shares down by 9.8%. It is one of the biggest car dealerships in the U.S., posted second quarter earnings that did exceed expectations. Shares, however, are trading lower. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that business flash. We are going to dig into some of the market moves today. I'm looking at the S&P 500 right now, still in the green, just a touch. Looking at across the sectors, we're seeing tech only up by about 0.2% here, a little bit pairing their rebound from earlier today. But we're going to talk about the tech trade and more with our very own Alexandra Semenova joining us in studio, our equities reporter. Alex, thanks for coming back in for us. Talk to me about the tech trade in particular today. I feel like it was in the green a little bit more, pairing back a little bit, but still seeing inflows when it comes to the tech trade.
Yeah, tech is, of course, the big story this year after rising more than 40% on the NASDAQ 100. And there's this cloud over tech right now because we have a flurry of earnings reports out of the sector next week. And the bar is so high because these companies have seen such a massive move higher. So there's a lot more room for downside than there is for upside. Bloomberg Intelligence actually estimates that S&P 500 companies are expected to report a profit drop of 5% this quarter, according to their data. And of course, you know, the sector isn't expected to return to profit growth until the end of this year. So there's a lot of pressure coming from what we might see in tech earnings. However, when it comes to tech companies, it's often not about the earnings results necessarily, but about what they say about any big breakthroughs. And of course, everyone's going to be listening to their AI progress. Do they actually have anything to show for it, or is it going to be a matter of just mentioning this key buzzword on the calls? So investors are probably doing some profit taking right now as they wait for those results and see what happens.
Yeah, it's interesting. Kroger, for example, I think that's the one we always go back to. How many times did they mention it on the call, AI on the call, even though they're a grocery store chain? Look, I want to talk about narrow concentration. Top 7 stocks have driven S&P 500 returns this year. But now they're trading at a substantial premium. I know you wrote something this morning about from the view from Bank of America about perhaps this rally could broaden out. What's the thinking there?
Yeah, so of course there's something for the bulls and something for the bears in this market. The bears keep pointing out that this narrow leadership is a reason to kind of stay away from stocks, that we're in this bubbly AI-powered market, and that if we do see the Fed hike more than investors expect, then we could see valuations come down a lot. But then, the people who are a little bit more bullish, who are changing their tune on stocks this year, are saying this is not something to worry about. It's not the doom and gloom scenario that everyone thinks it is. You have Bank of America Corp, which has kind of been taking the lead on this argument that the S&P equal weight is actually going to outperform the S&P 500 for the rest of the year. Some of the laggards catch up. There are, history does show that when you see this type of extreme concentration, it usually triggers a mean reversion. So you start to see some of the other companies outperform. Savita Subramanian again this morning said that the top 7 stocks trade 44 times trailing earnings versus the rest of the index 17 times earnings. So that leaves a lot of opportunity for upside. So investors are expecting that this rally could broaden out. It's been broadening out since May, and we're seeing a continuation of that trend.
Well, I can't remember if it was, I think it was while you were out, maybe Jess did a story on Jess Metten, our equities team lead.
Elena, indeed.
Okay, and they talked about the good first half of the year often indicates a great second half of the year as well, historically. How does that compare with some of the calls that you're hearing from strategists and analysts that you speak with?
Yeah, so the strategist target revisions that we're seeing on the S&P 500 kind of speak for themselves. We went into this year, sentiment was very, very bearish last year, and we saw the low in October. Now, a lot of people are saying that the market bottomed out in October, that it was the beginning of a new bull market when stocks rebounded. But a lot of investors were still worried about recession expectations, aggressive rate hikes, and so they didn't see this rally coming. You have the S&P 500 up 18% year to date, an incredible run in technology stocks, when many strategists were predicting that they would really go nowhere, or that we could see maybe a drop into the middle of the year and a little bit of a rebound to see stocks end flat. But here we are. It's the consensus projection was about 4,000 on the index. It's being upwardly revised now. It stands at about 4,200, which is still well below where it's trading right now. And they're kind of being cornered into changing their calls as clients ask, why aren't we seeing these big juicy returns from technology? Why are we staying away from stocks when the market has, outperformed? Why are we sitting on cash?
Right. It's really interesting, Alex, and is a great segue into our next segment here. Alex Semenova, thank you so much for joining us to talk about the trade and the outlook for the second half of the year. And speaking of the outlook and bullish calls, we've got a great guest on here. We've got Gina Bolvin, the president of Bolvin Wealth Management, coming on. And Gina had a bullish call in January about a 15% rise in the S&P 500, one of the only strategists that we were having on at the time with a bullish call. So really excited to chat with her. Gina, thank you so much for joining us on this Friday. As we were just talking about with Alex, typically a good first half of the year can lead to a good second half of the year as well. Given the bullish call that you had back in January, are you still bullish for the second half of the year?
So I am. First of all, thanks for having me back on. And you're right, in January I came on and I said the market was going to be up 15% by the end of the year. Although I thought it would take all year to get there, we had thought the second half was going to drive most of the gains, and it was really the first half, which goes to why I tell clients that you cannot time the market. We are bullish, however, and we do think that this is a strong, confirmed bull market. However, we think that this young bull market is due for a pause. We've come so far, so fast, And even healthy bull markets have corrections. An average correction might be 12 or 13%, but we still think 12 months, 18 months out from now, we think the market will be higher than where we are now.
Yeah, I mean, describe to me how that pause happens. What does it look like? Which names are going to be in focus? Is it the tech names that have had this incredible rally and been leading this stock market higher?
Yeah, that's exactly right. You know, we're expecting technology to take a pause. And what's going on today at 4 o'clock today, the NASDAQ 100 is going to rebalance, and we're going to see those top 5 names: Microsoft, Amazon, Apple, Alphabet, and NVIDIA. Those weightings are going to be taken from 43% to the NASDAQ 100 down to 38%. So that's going to cause some volatility. And there's a very high bar to clear because those stocks and the whole tech sector has done so well. So yeah, but the Fed isn't out of the way either.
That's right, but this options expiration, like how much of an impact does that have? Because it seems sort of idiosyncratic on some degree. Does that permanently change the mood in any of these big names?
Not really. You know, we're really looking at, where we're going to be more longer term, even 12 months from now. And once a bull market is confirmed, the average return is 19% 12 months out. So the average bull market is 5 years. So we think that this market has legs and it's going to continue, but short term, there could be a pullback. And, next week is a big week with the Fed as well. He's expected to raise rates by 1/4 of a point. It'll be interesting to see his comments and how hawkish he is.
Well, as he usually does, I feel like he leaves himself open to the totality of the data and gives himself a little bit of flexibility there. Having said that, though, I'm really interested in your recession call as it relates to market sentiment, because the Dow posting a 9-day winning streak 25 times since 1950. Only 3 of those streaks happened within a recession year. Where do you see evidence of a recession given the technicals of the market and what we're seeing in the economy?
We actually think that the odds of a soft landing have increased, and the consumer has really, the consumer is 70% of the economy, and the consumer is still spending. I think earlier in the year, a lot of people predicted that the consumer would, rein it in a little bit more because inflation was so high. Many strategists talk about FOMO, fear of missing out in the market, and I'm really focused on YOLO. The consumer has been underestimated because COVID has given them that YOLO, you only live once mentality, and they're continuing to spend. A recession could be likely, but that doesn't necessarily mean the stock market's going to go down. Once a recession is called, or we know we're in a recession, the market usually rallies because the market's forward-looking. If we do have a recession, we do think it'll be mild, but it's really going to be based on, the labor market as well, and that's something to keep an eye on.
Yeah, and we get data around that as well next week. Okay, so if this bull market is due for a pause, where do you hide out in equities right now?
Well, I don't know that you hide out. We're a little neutral on technology. We were overweighted. We went from overweight to neutral on tech. And we do like industrials right now. There's a great offshoring trend that looks very attractive. We also like medical devices. And, you might want to start looking at small caps and mid cap stocks. I think it's a little early, but they haven't done that much. And that's where we're at right now.
When you think about small caps and mid caps, what are you looking at to determine which kind of secondary plays are going to be the most successful and effective?
Well, small cap stocks are very economically sensitive, and as we head out of a recession, they generally tend to lead. So that's something that you would want to keep an eye on.
And in the moment that we're in right now, too, I'm curious, do you think that we're about to enter kind of an era of dividend plays? Is that going to be the move moving forward?
Well, that goes more to value stocks. And I do think that growth stocks will continue to do well. And I would tell investors to have a barbell approach, to have some growth stocks and some value stocks, some dividend plays. But also keep in mind that, as rates are so high, interest rates, that this is going to be good for fixed income investors. And now you're going to be able to get a higher yield off money market accounts, and bonds could do well. So you could also get higher yields through fixed income with less of a risk than investing in stocks.
Let's turn back to the consumer for a moment, because I've had my eye on a bunch of consumer-oriented earnings, and we've been talking about how that is such an important piece of the economy. Take me through, we have this potential for just some weakness that we've seen, trading down, maybe not buying as much from some of the consumer packaged goods side. At the same time, we've got travel, where Delta and the like are still seeing this enormous demand, especially for international travel. Where is the consumer now? Is this a bifurcated sort of high income, low income situation?
Absolutely. And but and that segues right into inflation, right? The lower end consumer is hit more with inflation. They feel it more. But we expect, and one of the reasons why we continue to be bullish, is we expect inflation to be at a 3 handle by the end of the year. And that is really going to help the lower end consumer. Yeah. And that's going to help them spend more. We are starting to see inflation come down. The reason we think it's going to be down by the end of the year is we had a blowout housing number where multifamily houses, building permits for multifamily housings is booming. We haven't seen this type of activity in decades. When this supply comes to the market at the end of the year, that's going to put a downward pressure on rents. Yep. And that's the majority of CPI. And that's why consumers are going to continue to spend. We're going to see rents coming down, inflation coming down, and they're going to have more money in their wallets. It's also because the job market has been so resilient and so strong. And when consumers have jobs, they will continue to spend.
Yeah, we continue to see that strength in both the labor market and with wages as well. Gina, thank you so much for joining us. That was Gina Bolvin with Bolvin Wealth Management, making the call on the 15% gains in the S&P in January. Still seeing some evidence of a bull market, but maybe some room for a pause as well there. Stick with us. This is Bloomberg. Let's get some company news with Bloomberg's Steve Rappaport.
Shares of Amex are down more than 3.5% after the company reported second quarter revenue that missed estimates as spending growth on its credit cards slowed. But analysts highlighted Amex kept its forecast for the year steady. American Express is facing tough comparisons to recent quarters due to a boom in travel and entertainment expenses as pandemic restrictions eased. Passengers were literally hot and bothered, and now Washington is demanding answers from Delta about a scorching delay in the desert. Bloomberg's Joan Doniger reports.
Steve, the Department of Transportation wants to know why passengers on a flight from Las Vegas to Atlanta were left to fry in the fuselage as the plane sat on the tarmac at Harry Reid International Airport for several hours on Monday. According to social media posts from people on board, some passengers became ill and fainted. Others reported Delta didn't provide water to passengers and the bathrooms were closed. The airline, in a statement to ABC News, apologized to customers and said it's looking into what happened. Temperatures in Las Vegas reached 114 degrees that day. Steve?
Thanks, Joan. According to the Department of Transportation, airlines are required to provide comfortable cabin temperatures during delays on the tarmac. Delta stock up less than 1%. And according to Sorry about that. Buyers will like it, but dealers not so much. AutoNation's top executive warns softening car prices will likely fall further as inventory grows. AutoNation reported gross profit on each new vehicle sold plunged 25% in the second quarter. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Good morning. This is Simone Fox.
From Bloomberg World headquarters, I'm Charlie Pellet, 12:21. The time now on Wall Street as we take a look at some of your top business stories and we check markets. The Dow, the S&P, NASDAQ, all moving higher. Right now we have got the S&P up 14 to 45.49. That is a gain of 0.3%. The Dow up 80 points, a gain there of 0.2%. NASDAQ up 22, higher now by just about 0.2%. 10-year yield 3.82% with a 2-year at 4.85%. Spot gold down $8 the ounce to $19.61. Drop there of 0.4%. West Texas Intermediate crude up 1%, $76.41 a barrel on WTI. The slide continues for both Netflix and Tesla after earnings. We've got Netflix down another 2.8%. Tesla moving lower again today after its earnings report. We've got shares of Tesla down now by another 0.5%. So again, recapping, equities are higher. S&P up 14, a gain there of 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie, thank you so much. And sorry for cutting in on you there in the beginning. Charlie Pellet, one of my favorite people at Bloomberg. Just want to give you a quick update on a headline coming across. The Teamsters Union saying labor talks with UPS will resume on July 25th, very close to the deadline for their contract with UPS to expire. And of course, if the Teamsters go on strike, that could have a huge impact on trade in the United States, potential for GDP impact. But let's change gears, get to Evangelos Momios. He's an equity analyst with Bloomberg Intelligence, because we have some big news from the credit card companies today. Amex, American Express revenue missing estimates, card spending growth slowing. Evangelos, what exactly is happening here? Is this all just weakness around the consumer, or is this something more fundamental to American Express's business?
Yes, like you noted, they missed on revenue, but revenue expectations were somewhat inflated. Revenue still grew quarter over quarter. So the U.S. consumer continues to spend and continues to use his or her credit card. Delinquencies across the board, not only for American Express, but also for those that cater to lower credit profile customers like Capital One, Discover, and so forth, delinquency rates have been going up. They have been normalizing from very good levels post-pandemic. But the big stories are that the growth is still robust, albeit a little lower than last year. Delinquencies are going up, but in a controlled sort of fashion. Net charge-offs, those are credit losses, are also following the same path as delinquencies with a delay. So overall, probably more about inflated expectations and less about any huge negative surprise from the credit card lenders this quarter.
Well, talk to me about those delinquencies specifically. Where are we seeing the most pain for consumers there?
Yeah, so the interesting point is that delinquency rates in the second quarter, as I said, went up. They went up less than they did in the first quarter, for what that's worth. We don't have exact breakdown by FICO stratification, but what they do tell us is that, what the companies tell us is that people on the lower end of the FICO tier are being more delinquent in their payments than those at the higher level of the FICO tier. And that's also evident when one compares the numbers between those that focus, again, on higher risk profile customers like Synchrony Financial versus those that focus on prime, super prime customers like American Express.
How long do the executives of American Express and others, how long do they see some of this weakness, especially amongst the lower end consumers? How long do they see that lasting?
It's very difficult to predict, but what we can say if we look at longer periods is that generally for delinquencies to continue to increase, you will have to have some deterioration in the employment situation, and unemployment rate remains very low. So most of those executives on their conference calls, they will tell you that we cannot predict the market, but the economy, but we have to be ready. So they are beefing up reserves ahead of that potential development. But so far, the consumer is holding up better than expected, although, as I said, it's a situation that is normalizing from prior years.
Well, even though the consumer is holding up better than expected, we're still, I mean, it's such a weird vibe right now out there because there's so much good news and bad news all the time. And one of the pieces of bad news is obviously in the commercial real estate space. To what extent do you see in your research that investors are kind of scrutinizing Capital One, other banks, and credit companies due to commercial real estate exposure?
Yeah, like you insinuated in your question, this is more of a bank issue and less of a credit card issue. Of the company's focus in credit card lending, Capital One is one that has some commercial real estate exposure, but it is insignificant compared to that of other banks. To the extent that the commercial real estate pressure reflects some deterioration in economic conditions that could affect the employment situation, then it will be an issue for credit cards, but nobody's making that connection yet.
I mean, differentiate between some of these credit card companies for me. I believe you write that American Express is better positioned for growth from here on. Is that because of the, I guess, income level of their consumers, or is there some other rationale?
Yeah, so there are two characteristics. The one that you just mentioned, they focus more on super prime consumers. But the other characteristic is that unlike the other credit card lenders, their revenue comes mostly from purchase activity and less from interest earned on outstanding balances. So in that respect, they are not that directly impacted by interest rate levels, but they're more impacted by how often we use our credit cards and for how large transactions. So when you see people travel more, when you see airfare going up, hotel prices going up, all that is good for American Express, not as good or equally good for someone like Capital One or Discover.
So just to continue this competition between the names that we're talking about here, is Amex the best positioned of those names to benefit from increased consumer spending? What's the kind of hierarchy?
Yeah, in my opinion, although we don't make recommendations on the stocks themselves at BI, what we can say is that the fact that American Express is more focused on prime, super prime consumers, it's more sensitive to spending than outstanding balances. They have an international presence. All those characteristics will make it hold up better if there is a recession, a consumer recession, which is the fear right now. So as a result, I think they're best positioned compared to others. Although I would reiterate, it's not like others are falling off the cliff. It's just that things are not as great as they were for them a year or two ago. And like you said, it's a very strange environment.
We've talked a lot about the health of the consumer here, but are there other things, compliance, regulation, that stand to put these credit card companies to the test?
Yeah, there is an outstanding issue with a limit on late payment fees that is under consideration by regulators and the industry. If it comes into effect, it's going to be sometime next year. We don't know the final form, but it's an issue that would impact disproportionately those companies that sponsor co-branded cards, meaning the kind of card you will see from your retailer without knowing exactly who issued it. So those are, in order of importance, Synchrony Financial, Bread, and to a lesser extent, Capital One. So it's something that we keep an eye on, but it's not finalized yet.
I always wonder exactly who is, behind my credit card whenever I get one of those retailer cards, because it's always such a question mark for me.
Yeah, and I feel like it's a question mark for a lot of consumers, and this is why this space is so interesting to watch as an indicator of consumer health, as you know, better than anyone, Simone. So really interesting here. I think we got to leave it there, but thank you so much for joining us. And Simone, I can't wait to continue to hear your take on kind of the consumer health when it comes to some of these names and other ones.
And it's so interesting when you're looking at kind of consumer credit because we are seeing some of these signals about, auto loan credit deteriorating, consumer loan credit deteriorating, and all of this, of course, with interest remaining high. So we're going to have to see exactly how that factors in to the health of the consumer, particularly as we enter a big week for consumer earnings. This is Bloomberg. Now let's get some world and national news with Bloomberg's Nathan Hager. Nathan.
Okay, thank you. The trial date is set for former President Donald Trump in the classified documents case in South Florida. U.S. District Judge Aileen Cannon has scheduled it for May 20th of next year. That puts the trial at the heart of presidential election season and could complicate things for Republicans if Trump is their nominee. That's according to Brown University political science chair Wendy Schiller.
How do the Republicans get around that? They're going to want to mobilize their base for congressional elections and the presidential election, but how do you actually get those voters who have rejected Trump for 3 elections in a row now to come back in the middle of a trial?
Brown University's Wendy Schiller joined us earlier on Bloomberg Markets. A new poll of a key swing voter bloc shows a tight race right now for both President Biden and former President Trump. AARP surveyed women over 50 in 40 competitive House districts. 48% of them favored President Biden, 44% backed Trump. Florida Governor Ron DeSantis fares better in this poll of 50 or plus old women. He ties with Biden at 46% apiece. New York City's congestion pricing plan is now facing a federal lawsuit. New Jersey filed that case today. It says the Federal Highway Administration ignored the impact on Garden State traffic when it approved the new tolls. Easy Pass drivers would be charged up to $23 to commute in south of 60th Street. Supporters say the plan could cut Manhattan traffic by up to 20%. The president of Texas A&M University has resigned as the school votes to examine the mishandling of a prominent black journalist's hiring. Catherine Clark submitted her resignation letter late last night. The school has been embroiled in controversy since it hired former New York Times editor Kathleen McElroy, then repeatedly changed the terms of her job offer. The statement says McElroy was a victim of anti-woke hysteria over her research on diversity and inclusion. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here on Bloomberg. The NASDAQ 100 index fluctuating between gains and losses right now. We'll call it unchanged. Did turn negative briefly just a moment ago. Right now it is up by 1 point. NASDAQ Composite Index holding on to a 4-point gain. Also little changed. S&P higher by 10, up by about 0.2%. And the Dow higher now by 52 points. That is a gain of just about 0.1%. We've got the 10-year yielding 3.82% with the 2-year at 4.85%. Spot gold right now down $7 the ounce to $19.62. That is a drop for gold of just about 0.4%. Crude oil, West Texas Intermediate up 1.3%, $76.61 a barrel there. Bitcoin still below $30,000 at $29,827, up by about 0.3%. Tech names have been under pressure in recent sessions. Adam Coons is portfolio manager at Winthrop Capital, and he was interviewed right here on Bloomberg Markets.
We're not surprised to see a pullback here. We think that will continue as long as valuations are stretched and are really narrative-based moves in stocks. We think that, investors are wise to fade that trade.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Among some of those tech names, we've got Tesla now higher by 0.6%, have been lower earlier in the session. Netflix extending its losses down by 2.6%. We're also keeping an eye on American Express shares after earnings. American Express's second quarter revenue did rise less than analysts expected. Shares of American Express down now by 3.4%. So again, recapping here, NASDAQ lower by a point, S&P up 8, a gain there of 0.2%, 10-year yield 3.82% with a 2-year 4.85%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, as always, Charlie. And as Charlie was mentioning, seeing a little bit of movement in the tech-heavy NASDAQ after Netflix and Tesla earnings. A bit disappointing. We saw the NASDAQ dropping by the most in 5 months after those earnings. And this gives us a really good excuse to kind of dig into the EV space after those Tesla earnings. And we've got a great guest joining us to give us a look at not just the EV space, but specifically EV charging, which is a really interesting space to be looking at. We've got Josh Aviv on the line. He is the founder and CEO of Spark Charge. Josh, great to speak with you. Thanks for joining us here on this Friday. Before we get into kind of the overall charging space when it comes to EVs, talk to me just about Spark Charge specifically. What do you do? What do you provide?
Absolutely. So at Spark Charge, we charge electric vehicles in a mobile fashion. So that means we actually deliver and bring the range to the electric vehicle. The same way that you would order a pizza on your phone to get delivered to your front door, we bring the charging station to your electric vehicle, whether you be at home, at work, out on the go. We make charging simple, convenient, and easy.
This is one part of your business is to consumers, to people who get stuck, and then also to rental companies, I understand. Give me a breakdown. Where does most of the revenue come from? I would assume rentals, right?
Absolutely. So earlier this year, we launched our fleet charging business, where we actually now go out and service fleet customers. So you're talking about companies that have, anywhere from as low as 5 all the way up to close to 1,000 vehicles in their fleet, electric vehicles in their fleet. We go out and we service them. We offer a turnkey service where basically we can show up and start charging every vehicle every single day. They no longer have to worry about trenching, digging, tunneling, cabling, submitting RFPs, where they install the charging stations. We show up with our mobile charging stations. We plug into every single vehicle. We charge every single vehicle, and we make it so that they can grow and scale their fleets almost infinitely.
So as you know, one of the potential big boons for a name like Tesla is offering its own charging network to other companies like Ford EVs, for example. I wonder, does the kind of democratization of Tesla's charging networks, is that good news for you guys or bad news?
It really is good news. I mean, when you think about it, the market from its inception was, we're going to go with CHAdeMO for, DC fast charging. Then it moved to CCS as the dominant charging provider, dominant charging plug. Now it's, North American Charging Standard is slowly starting to look like it's going to become the dominant plug that, EV OEMs will use to charge their vehicles. I think that's really good. I think we need one standard. I think, trying to juggle three balls in the air and figure out, well, does this car take CHAdeMO? This one take CCS? This one take NACS? I think that's very difficult for not only OEMs, but charging station manufacturers like ourselves to kind of justify and keep up with. I think if the industry moves with NACS, it's great for everyone. It's a great standard. It's very much developed and tested. So I think it'll be great for the entire industry.
Yeah, and it seems like some of the car makers are getting on board with that, certainly. I mean, the question I have about mobile charging, what's the outlook? Because we do expect to see an infrastructure around these mobile charging stations, grounded mobile charging stations, grow substantially over the next couple of years. Can mobile charging really play into that when there's ultimately, hopefully, going to be more infrastructure?
Absolutely. So when you think about it, mobile charging will always be able to scale faster than infrastructure. Right now, if we decided, Spark Charge and Bloomberg said, hey, we want to put a charging station in the ground, a DC fast charging station in the ground, it's going to take anywhere from 18 months on the low end to as high as what we're hearing is 4 to 5 years on the high end. And that means that if you really want to have infrastructure at scale, the only real way to do that is through mobile. So mobile will always be able to scale faster, charge more cars in geographical areas that a lot of fixed infrastructure just can't reach. And so as the EV industry continues to grow, it will inevitably have to rely on mobile charging to do so. The fixed infrastructure will never be able to keep up with the amount of cars that are being sold on a daily basis. And so at Spark Charge, we look at that and we say, okay, well, we're definitely going to install charging stations, but there's going to be applications where installing 1 or 2 or 5 charging stations cannot meet the demand of that area. And mobile charging is the only option that can come in there, take over, charge those cars on a daily basis, offer a seamless experience that those just fixed charging stations cannot. And we're seeing that right now. We're on track over the past 6 months, or basically year to date. We've onboarded more fleets, more EV companies than a lot of fixed charging stations have over their 5-10 year lifespan in the business. So the industry is definitely moving towards mobile and definitely loving the fact that mobile is seamless and easy to use.
All right, so let's say I rent an EV. I'm on vacation. I'm taking a road trip for some reason, and I end up in a little bit of a middle of nowhere situation. I'm not near a charger. Do I call a Spark Charge person to get access to your on-the-road mobile charging? Is that something that's in the cards for you guys, some like an on-demand service to that degree?
Absolutely. In fact, it's already in the works. If you rent a car through Hertz, if you run out or if you feel as though you're even getting low, they will actually be able to dispatch one of our mobile charging units to you so that we can charge your car if you're sitting outside the hotel, if you're on the side of the road. So we're already seeing applications like that being put into effect. In fact, that program has been up and running, I believe, for the past couple of months, and it's gotten used.
But we still have the issue of impatience. Like, I am never going to sit on the side of the road for 2 hours or more while my car is charging.
Even if you had to?
I would not want to rent an EV because of that, and maybe that's me being a bad consumer, but that's just the truth. How are you hedging against that issue when it comes to consumer behavior in our final 30 seconds here?
Absolutely. So the good news is that you wouldn't have to wait for those 2 hours. In fact, in most areas, and especially most metro cities and areas that we service, our SLA is actually closer to 60 to 75 minutes. And then we use DC fast chargers. So when we show up, we're not trickle charging your car. We're DC fast charging your car at a rate of up to 125, sometimes 150 kW. So we can actually get you off the side of the road once we show up in under 10 minutes, and you're back to enjoying your day. So no 2-hour wait, no being stuck on the side of the road. We're in, we're out, we're getting you back to enjoying your electric vehicle.
Maddie, could you stand that?
He's still thinking out. I don't know.
It's
I don't know.
hard.
But it's a really great look at the space. Josh, thank you so much. Josh Aviv there with Spark Charge. Stick with us for more coverage coming up on the markets and everything else you need to know for your day. This is Bloomberg. Let's get some company news with Bloomberg's Steve Rappaport.
A tornado that struck a Pfizer manufacturing plant is stirring up concerns about the U.S. drug supply chain. Let's get more on that from Bloomberg's Jeff Bellinger.
Steve, hospital drug buyers are scrambling to figure out how tornado damage at a Pfizer plant in North Carolina will affect the availability of medicines nationwide during record-high drug shortages. Healthcare service providers Premier and Vizient say they are turning to other drug companies to see who can ramp up production. Hundreds of medicines, including cancer drugs and antibiotics, were already in short supply before the tornado hit.
Thanks, Jeff. Shares of Pfizer currently up 1.25%. The top dog in the AI chip game has competitors nipping at its heels. Bloomberg's Gina Cervetti reports.
Steve, startups are looking to capitalize on a surge in demand and a shortage of NVIDIA's new products. The Financial Times reports Samba Nova, GraphCore, and TensTorrent are among the companies developing alternatives to challenge NVIDIA's dominance. Those three have raised more than $3 billion over the years, according to data collected by Dealroom.co, which tracks private tech deals. NVIDIA is the world's most valuable semiconductor company, with its valuation crossing the $1 trillion mark in May. Steve?
Thanks, Gina. NVIDIA stock is down more than 2%. To the moon, Amazon. The company plans to build a $120 million satellite processing facility in Florida in its quest to sell internet access from space. Amazon intends to launch more than 3,200 satellites to make it happen. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Hi, everyone. Simone Foxman and Maddie Mills here. We're looking at some green on the screen, but not too much going on in those equity markets. Not much going on in the Treasury market either, with yields just slightly weaker today. But let's get now a world and national news check. We go to that for Denise Pellegrini. Denise.
Yeah, thank you, Simone. We got a lot going on in politics because the date is set now for former President Donald Trump's classified documents trial. Bloomberg's Nathan Hager reports from Washington.
May 20th, 2024. That is the start date chosen by U.S. District Judge Aileen Cannon following a closely watched pretrial hearing this week. This means the former president's trial will begin nearly 6 months before the presidential election. It's a setback for both sides. The Justice Department had been aiming for the trial to start this December. The former president's lawyers asked for a delay until after the presidential vote. Trump is facing 37 federal counts tied to his handling of classified documents at Mar-a-Lago. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thank you, Nathan. Meantime, story up on the Bloomberg terminal, guys. If Donald Trump returns to the White House in 2025, he is promising to do a bunch of controversial things, including barring babies born in the U.S. from automatically claiming citizenship, banning transgender people from the military, holding elections for school principals, and ending the war in Ukraine. Story says that's according to Trump himself, and the report says his plans also include ousting civil servants in national security and law enforcement and ordering the Justice Department to criminally investigate President Biden. New Jersey Governor Phil Murphy, along with several lawmakers, including Senator Bob Menendez, announcing plans to sue the Federal Highway Administration over the new MTA's congestion pricing plan in New York City. Here's Menendez on that.
They should abandon their arrogant plans to charge up to $23 a day to out-of-state commuters who are facing high tolls and rising costs of life as it is.
They say they'll do what it can to make sure that they prevail in this. Meantime, some good news. If you work remotely from New Jersey, if you're subject to New York's income tax because of it, you can now claim a credit against your New Jersey state tax. And this new law, signed by Governor Murphy, could also incentivize, as you can imagine, more workers to move to New Jersey. Global News 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Denise Pellegrini, and this is Bloomberg. Simone, Maddie, back over to you.
This is my meal. I call this girl dinner. Girl dinner. Girl dinner. Girl dinner.
Well, we have the perfect time to talk about this viral trend, girl dinner. We just come from Denise, and you're here with Simone, me, and Maddie Mills. Maddie, do you girl dinner? And please tell our audience what exactly this trend is, because I have to be honest with you, I did not know.
I'm a big fan of girl dinner. It's the highlight of my career that I got our producers to play us the girl dinner sound there. So thanks for playing ball with me, guys. Girl dinner is a very important trend that's been happening on TikTok that showcases what the ladies, the girlies are eating for dinner, which is basically a compilation of snacks so that I don't have to actually be an adult and cook a dinner. One of the examples that we've got here in this story on the terminal is this company, Conagra Brands, which sells Slim Jims, Boom Chicka Pop popcorn. The combo of those two, a classic girl dinner. You're not cooking. It's a compilation of snacks. And snacking continues to be a huge key tenet of American food culture, Simone. So this is becoming a key market as well.
So I guess from the market's angle, we could see this potentially play out in earnings next week, since we have a lot of these consumer packaged good companies coming. I mean, I guess as the Conagra CEO was talking about, demand, unit sales change, ending in mid-June for salty snacks was actually a little bit up, and a lot of the other categories down. What does your girl dinner consist of?
I usually do a little bit of hummus and then like a meat product, and then maybe a sweet thing as well. And that's my entire dinner.
Is there a glass of wine in there?
Oh, my Simone.
I feel like I see these TikTok
Simone,
videos.
you know me.
And I have to admit, I'm not a huge TikTok person. And they all feature some cheese, some nuts, a glass of wine.
Maybe a nap.
A glass of wine, and maybe a nap could be on the cards for this weekend. That's it for us. Sound On with Joe Matthew starts right now.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, barreling into a triple header of central bank meetings with inflation cooling around the globe, all as the riskier credits continue to outperform. We begin with the big issue, waiting for the Fed.
The Fed and their tightening campaigns
widely assumed they're going to hike in July.
July is baked in the cake. Higher for longer.
Hike by 25 basis points.
The Fed might need to get a little bit more aggressive here.
Inflation data coming down faster.
Not a lot of indication yet of greater labor market weakness.
Consumers showing up. There's been some really welcome news for the Fed as of late.
The last inflation print was quite low.
Expecting inflation to come down.
The economy is going to surprise people by its resilience.
The data is kind of starting to show us that maybe we won't have that recession.
What is the right inflation target for the world we're living in today?
How high will they be willing to tolerate?
At some point, we do think the recession is going to come.
Joining us now, I'm thrilled to say we have PIMCO's Tony Crescenzi and Bank of America's Megan Swiber joining me on set on a Friday. So must be my lucky week. And we're, of course, meeting before the Fed meeting next week. And Tony, getting away from the how many more hikes are left, it seems like July is baked in at this point. How long might this Fed be on hold?
Well, the view of rate cuts flies in the face of Paul Volcker, the legendary Fed chair, and his idea of keeping at it, of course, the title of a book he had. Chair Powell, over a year ago, said that one of the three lessons of history is to keep at it, to sustain the higher rate of the Fed funds rate in order to keep the pressure on inflation, downward pressure on inflation. The Fed doesn't want to make the mistakes that have happened historically, which is to cut rates prematurely. So you should expect the Fed to keep at it for some time until it's clear, and by clear we mean through inflation expectations, that the job is done, because the inflation data alone won't cut it. The Fed has to feel that households are confident that the inflation rate will be down over the long run too.
And Megan, Tony brings up Paul Volcker, so let's talk about Ben Bernanke, because we actually heard from the former Fed chair this week. He weighed in on the next move, saying that it looks very clear that the Fed will raise another 25 basis points at its next meeting. It's possible this increase in July might be the last one. And Megan, if it's July and done, how does that work itself through the Treasury curve? How are you thinking about opportunities at the short end versus the long end?
Sure, Katie, great question. So what we see borne out in history is that you really want to be buying the last hike of the cycle, particularly further out the curve. So we do think that going long 10s as we're nearing the Fed's final hike makes a lot of sense. You usually see the 10-year rate rally around 100 basis points or so in the 12 months after the Fed's delivered that final hike. Markets right now are only pricing about a 10 basis point rally or so. So we think that those long positions are well served, but important to be putting them further out the curve. Because when you look at what's priced into the front end, and Tony was just making this point earlier, there's a lot of question marks around how long the Fed is going to stay on hold. But the market's pricing a full 25 basis point cut by the first quarter of next year. So we do think that there's more room for the curve to invert further. We like being long further out, but we do think that ultimately the cuts priced in right now are largely overstated.
And I want to get to the message that the yield curve is sending, but you bring up duration. I'm glad you went there, because we actually got the annual investment letter, one of the investment letters from former PIMCO CIO Bill Gross, and he wrote that with inflation back to 3% or so and the Fed nearing the end of its tightening cycle, it would appear to many that a new bond bull market is about to begin. But while I think that the 10-year at 3.80 may have peaked at 4% for 2023, a bull market is not in the cards. So Megan, you've got Bill Gross on the other side of the trade. Tony, where do you fall?
Well, you would say, and we would agree with Megan, in fact, 90% of the time since 1978, core bonds, those with duration, let's say, of 6.5 years, average maturity in the 7s or so, have outperformed cash, T-bills and such, 90% of the time by an average of 3 percentage points over a 3-year rolling period. So looking back, 3 years from now to today, it's likely that these longer maturities will fare well. And so it's a fool's game to some extent to keep playing the T-bill money market game. Blink and you may miss the next big bond rally. So the time is now for total return styled investing pricing to get the gains that Megan suggested could occur, because a move of 70, 80 basis points or so on a 10-year instrument means a lot in terms of price gains, and you never know when that'll happen and for what reason. And so now is the time, and his history suggests it, when the Fed is about to be done and with its rate hike cycle, call it a few months, that's the time to be investing in longer maturities, withstand, we would suggest, the volatility that could bring in the interim, because you can't time a diversifier as bonds are. And so we would suggest being leery about doing so.
So it sounds like the opportunity of cost of cash is very real right now.
And speaking over the long term, because, well, it is quite attractive, and you do want some liquidity, but you've got to be sure that you're getting a return for that liquidity. In short-term funds such as those that we have managed by Jerome Schneider, for example, the carry, the yield to maturity is in the zone of over 6% or so. But you want to be sure that you can part with the liquidity to get those yields, but we think there's always some, for many investors, I should say, ability to part with liquidity to get that extra yield closer to 6%.
And I do want to get back to the yield curve, because that's really been one of the big stories in the market, that extremely stubborn inversion that we're seeing and what it's actually signaling. Megan, I was reading your notes, and this stuck out to me, that the deeper curve inversion doesn't necessarily mean that recession risk is higher. Talk to us what you mean by that and what this curve actually is suggesting.
Sure, Katie. So I think that when we look at recession probability models, for example, right, they largely take into account the shape of the yield curve, the very deep inversion that we're seeing. And if you look at those, that would suggest that recession risk is elevated right now. But what the curve inversion is telling us, and what the curve tends to get right, is anticipating Fed policy action. So the curve inversion is really telling us this message, this expectation for the Fed to be cutting. But the Fed can be cutting for different reasons, right? So in recent cycles, right, the Fed is cutting alongside the downturn that we saw following the pandemic. It's cutting during the global financial crisis, but the Fed can be cutting this time. And what the market's actually reflecting is cuts alongside inflation moderating very quickly. So certainly we've gotten a lot of good news on this in recent inflation prints, but the market's pricing not only this perfect storm of inflation falling right now, but that continuing over time. And the Fed operating at a policy rate as aggressive as they are right now, over 5% after they deliver this next hike, ultimately will become more restrictive at a lower inflation rate. So it argues for them being able to cut alongside moderating inflation, which we think is really the message that the curve is telling us right now, not so much these cuts alongside a material growth downturn.
So in a way, just to draw this point out, it sounds like almost what you're saying is that the fact that the curve is this inverted is in some way an endorsement of the Fed's policy and their path.
Absolutely. And I would say that, the one thing that Powell can look back on and really see a lot of credibility on is the inflation market and five-year break-evens, which are the Fed's view into how the market's reading these longer-term inflation expectations that Tony mentioned. They've been consistently pricing the Fed being able to hit that 2% target over the long run, even alongside a lot of volatility in spot inflation. So there's a lot of credibility that the market is giving the Fed right now.
Katie, I was going to say, and agree with Megan, that it's the confidence in the Federal Reserve that it will keep inflation down, do whatever it takes, if you will, that is causing it in part. Secondly, there's what's called the term premium effect, which is the impact of Fed policy and the bond purchases that it made in the past on yields. Consider, for example, the Federal Reserve holds $2.5 trillion worth of mortgages. It has $5 trillion worth of treasuries. It took a lot of bonds off the shelves several years ago during the pandemic. So go to those shelves today. There are fewer items on those shelves, so the prices naturally are higher. As the Fed puts some of those items back on the shelves, the term premium, the additional yield you get for going out the yield curve, will start to rise, and so that will begin to affect yields. But the biggest factor, I would say, and agree with Megan, is the confidence in the Fed, a view on future rate cuts in terms of where yields are eventually going. And again, it's another message to investors to not wait too long in adding duration to turn toward total return style investing, income style investing, anything where you can get a capital gain in high quality assets.
So there's, 5 different points that I could dig into there that are interesting. But Megan, you also made the point that it's not just a recession that would cause the Fed to cut. We're in restrictive territory now. I don't think that's controversial to say. And just getting out of restrictive territory will require some rate cuts. So Tony, I have kind of a difficult question. Where do you think neutral is in this economy?
The PIMCO view since 2014 is that the neutral rate is somewhere between 0.5 point above the inflation rate, so call it 2.5 or so. It may be evolving. There's a debate about the impact of demographics, for example. We know that 1957, I've mentioned this fact before, it's the biggest birth year last century. So that means, fast forward 65 plus years later, big wave of retirement. It's the biggest wave in history. It's reducing the amount of labor supply, and this will continue through 2030, pushing up wages, and that could have an impact, for all we know, on the neutral rate. Secondly, there's this movement worldwide to invest in defense and to invest in the brown to green energy transition, et cetera, supply chains. All that might raise spending and reduce the saving glut that has kept interest rates down. It could also boost productivity, which can have an upward influence on the neutral rate. So so the jury's out, but we're sticking with the idea that it's lower than historical, and that'll keep yields low, and the yield curve probably reflects that.
And we don't have much time left, but I'd be remiss if I didn't mention that it's not just the Fed next week. Of course, we have the ECB and the BOJ as well. And Megan, when you look at that lineup, where do you think the most risk for a surprise comes from? Which region, which central bank?
That's a good question, Katie. I think ultimately the message that we're hearing across all central banks right now is this commitment to data dependence. So central banks right now are also pretty limited in terms of how much they can ultimately shock the market, because so much of the path forward here is really going to come down to the data. We're going to hear that from the Fed next week. The story is going to be a lot more about the focus around what they're ultimately going to do next. And at the end of the day, the Fed needs to be able to push back against some of this easing in financial conditions that we've seen following CPI, the relatively muted reading that we've recently gotten. So all of those things together do lend itself to central banks needing to keep that expectation out there for potential adjustments higher in overnight policy rates.
All right, a lot to look forward to. This is a great preview, you guys. Thank you so much.
Thanks, Katie.
Our thanks to Megan Swiber and Tony Crescenzi. Up next, it's the auction block. Big bank earnings driving the week of issuance. That's next. This is Real Yield on Bloomberg.
Replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where big bank earnings drove sales this week. The U.S. high-grade primary market saw weekly volume push past $30 billion, topping the high end of estimates. Wells Fargo was the main contributor, pricing two separate deals totaling more than $10 billion. I want to dig deeper into those banks as they saw some massive demand. Morgan Stanley, JP Morgan, and that Wells Fargo sale all saw their order books easily outpace their sales. And investors also piled into the leveraged loan and high-yield bond market. Just Monday alone saw 8 new loan deals and 4 junk bond sales. The week totaled more than $3 billion in high yield. Meanwhile, Gershon Distenfeld of AllianceBernstein says that the current environment presents a buying opportunity.
We think that bonds are back, so to speak. We're at yields now across the spectrum, going out even into corporates, emerging market debt, and other parts of fixed income, where the total return you're going to see, or the potential at least, is a lot higher than it's been for most of the past decade.
Joining us now, I'm pleased to say we have Maureen O'Connor of Wells Fargo and Zach Griffiths of Credit Sites. Great to have you both with us. Zach, I want to start with you. Between very bearish and pound the table bullish, where do you fall on this corporate credit market?
I'd say we are bullish, and really that's adjusted a bit recently. I think the move in high yield has gone a little bit too far, and so we did recently downgrade high yield to market perform from outperform, and that's not to say that we're moving to a cautious outlook on a high yield, but we are recognizing that the opportunity for spread compression from here is probably limited. Forward returns do look great on a 6-month and 12-month basis, and so we do think that's still a good trade, but we recognize that the possibility for additional tightening is probably limited, and we also maintain an outperform recommendation on investment grade. We have a spread target of 120 basis points, so are looking for a little bit more tightening there. So definitely in the bullish camp overall.
And Zach, I want to get to that high yield call, but let's talk about investment grade, Maureen, because right now IG spreads are already at 120 basis points, really close to the narrowest levels of this year. How much lower could spreads feasibly go from here?
Yeah, so I think we agree with Zach in that our longer-term view is bullish across credit products, including investment grade. But I think in the nearer-term sense, we're probably a little bit more neutral in that we've come very far, very fast. If you look at the index level, as you note, we are trading very close to the year-to-date tights, only about 5 basis points wide of the tights we saw back in mid-Q1. A lot of the higher quality industrial names are already trading at their year-to-date tights. So if there is any sector-level performance from here, it's probably within financials, perhaps further down the rating spectrum with some further spread compression across triple Bs. But as a whole, it does feel like in the nearer term sense, spreads are pretty fully valued in this current range, and we see a little bit maybe more downside risk to spreads over the next couple of months versus upside potential.
And let's talk about that narrowness that we've seen. It's come with really very little volatility. There was a really interesting report out from Barclays, I believe, looking at the past 3 weeks, Zach. High-grade spreads have traded within a range of just 3 basis points. That is the narrowest band in 18 months. And given that we're already at your year-end target for investment-grade spreads, what kind of volatility do you expect from here? Or could we just continue to grind sideways?
I think grinding sideways is a possibility, and the lack of volatility we've seen, I think, comes to interest rate volatility coming down quite a bit, at least in an aggregate level looking across the curve. And you've also had limited volatility in equities and FX. And so I think financial markets are coming around to the view that at least the Fed is almost done tightening. We are expecting a 25 basis point rate hike next week, and for the Fed to remain on hold for the remainder of the year. So I think a lot of the macro volatility that we've gotten gotten used to over the past year and a half is starting to subside. That's a positive for spreads. And so in terms of additional tightening, perhaps it's limited, but with yields at these levels, we think it's an attractive prospect and is likely to bring a tailwind of technical demand in the second half of this year.
Well, let's talk about that technical demand, because even with this conversation that we're having about a range-bound market, spreads fully valued, it's an important point that there's still a lot of demand out there. And Maureen, in your notes, you point out that if you look at the fund flows, people are clearly coming into that asset class. Break down the demand. What types of buyers are emerging here?
Yeah, you know, we're in sort of a bit of a sweet spot in that we've seen a return of the total rate of return buyers. So this is different than last year where we had, you know, record-breaking outflows across high-grade ETFs and mutual funds. That dynamic has almost reversed itself this year. We've had nearly unbroken inflows every single week into high-grade funds this year, with the exception of, you know, a couple of weeks right around the regional bank crisis in March. We've erased almost 80% of the full-year outflows we saw in 2022 to this point. So you have a return of total rate of return buyers chasing what's been about a 3.5% returning year for the asset class. But then on top of that, and as was noted, you know, with yields remaining elevated like they are, we still have a very attractive entry point for our more yield-focused buyers. So pension funds, insurance companies, LDI buyers. Yields are still trading about 150 basis points above outstanding coupons on the index. So you have this perfect storm of, you know, a number of different buyers chasing investment grade. All the while, supply has been pretty moderate this year. We're down about 3% versus last year's volume, so that technical has been quite strong.
Mm-hmm. And so that's the investment grade backdrop, a lot of demand there. I want to talk a little bit more about the high yield side of things, because we heard from Amanda Lynham over at BlackRock earlier this week saying that there could be weakness ahead in those riskier credits.
There's probably some scope for resilience still at the high end of the high yield spectrum. We don't view a recession as a necessary ingredient for an uptick in defaults.
And Zach, like you mentioned earlier in this interview, you recently downgraded the high yield market to market weight from overweight earlier this month. Where do you see as the fundamental backdrop when it comes to some of these junk rated companies out there?
I think you're really, Katie, seeing a bifurcation in terms of the lowest rated credits really showing signs of deterioration in fundamentals. And so triple Cs have performed very well so far this year, but we'd really emphasize very focused credit and security selection if you're going to go very far down the credit spectrum. If you remain up in triple Bs again, or double Bs, excuse me, that's certainly a very attractive place in terms of yield, and we haven't seen the deterioration in credit fundamentals. You're seeing a softening there, but we think it's really manageable at this point in terms of other factors in the economy, including plenty of cash on companies' balance sheets, providing some financial flexibility even as borrowing costs rise. We're really not looking for the maturity wall to hit until 2025. And so if yields and rates are still at 5.5% or 6% in terms of the policy rate going into the second half of 2024, that could really become an issue, but that's not our base case. And so we think that, you know, high yield is still a great place to be, but you need to be careful with your rating selection.
And Maureen, we don't have much time left, but I want to get your thought on the second part of what Amanda Lynham said, that we don't view a recession as a necessary ingredient for an uptick in defaults. When you think about this demand that we've seen for investment grade, would a recession scare away some of those buyers?
I mean, yes and no, right? I mean, what you'll see is ratings decompression, right? You're going to see investors gravitate towards the highest quality names up the stack, single A and double A rated names, and you'll see triple Bs underperform in that environment. Mm-hmm. But remember, our market is driven a lot by base rates, right? And so in a recessionary environment, treasury yields are likely to rally, and that rally will generate positive returns in fixed income, and those returns will attract those total rate of return buyers to the extent the losses that you see on the spread widening don't overcompensate for that move lower in rates, and that tends not to be the case. So said another way, we would still expect to see investors buying investment grade as a safe haven play, and also a place where you could still potentially eke out some positive returns even in a recessionary environment.
All right, Maureen and Zach, got to leave it there. Really appreciate your time, and a reminder that right now President Biden is now speaking following a meeting with 7 leading artificial intelligence firms about a new agreement for AI safeguards. You can check that out at LiveGo on your terminal. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, we have the NASDAQ rebalancing Monday, Tuesday, tech earnings Wednesday. It's the Fed's rate decision. Then we have the ECB on Thursday, and Friday, it's the BOJ. Global central banks, the one to keep an eye on from New York. This is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome to Bloomberg Markets. I'm Amber Canwar.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets on this Friday afternoon. We're looking at continued gains on the S&P 500 right now, trading at 45.51. It is defensive sectors that are pushing us higher, but higher nonetheless. You've got utilities rising, energy rising, as well as healthcare. In terms of the yields, the 10-year is coming down a little bit as investors buy those bonds, but they're selling the 2-year. So we're looking at 485 on the 2-year, 383 on the 10-year. The curve gets more inverted. The Bloomberg U.S. Dollar Index continues its gains after a big drop last week, down to 1,200. Now we're back up to 1,214. And oil also continues to climb, with NYMEX rising $1.15 a barrel to 76.80 for WTI. Amber, what are you looking at?
While earnings are not helping the tape, as you mentioned, it is a defensive rally. If you take a look at shares of American Express as well as CSX, disappointing in one way or another. American Express, while its record profit, their growth, their spending growth was as low as it's been in years. On the flip side, you do have some stocks that are working. Zoetis, I find this one interesting. It's the best performing stock on the S&P 500 right now. Zoetis is. And the reason that it is rallying is because its rival came out with a flea and tick medicine that Zoetis is viewed as having a better drug offering. That's good for a gain of about 7%. Airbnb rallying, as well as some other tech companies that are not in the Magnificent Seven, Matt, because of this rebalancing that's taking place within the NASDAQ 100.
All right, very interesting movers there. We'll continue to watch. The big story, though, heading into the weekend is the NASDAQ 100 rebalance, with new weightings expected for the big 7 tech names. I am talking about, of course, Apple and Alphabet. Here's what Sarah Hunt at Alpine Saxon Woods is watching on the rebalance.
You look at what happened to Netflix and Tesla. The question is going to be around operating margins and the fact that tech is seeing some margin issues. Now, these are particular stories, so I don't want to extrapolate into the full of the technology spectrum. But I think the question going forward is, yes, you have a Fed now that is going to be looking at, we still have a very strong labor market, so the odds of them doing something in July are almost 100% at this point. And the question really is going to be, can companies continue to adapt and adjust and continue to keep their earnings where they are? And that is going to be the biggest question, because the expectation for earnings is going higher in the fourth quarter, and that's going to be a question.
All right, let's bring in Bloomberg's Isabel Lee, who has been tracking the developments. Are we seeing it show up in trading today?
So we are seeing increased volatility, and this is really the big story. The NASDAQ is going to rebalance. It's going to take effect on Monday. So you can expect that today, it's the last day that investors can line up their portfolios to mirror the NASDAQ. So you can see big moves from the likes of QQQ, which is the biggest ETF that tracks the NASDAQ. So one of the things we are looking at is, are people putting more puts to the stocks that are seeing their weight cut? And we're seeing that bets are more on the downside. And another wrinkle to this, Amber, is that it's the OPEX, the monthly options expiry. So $2.4 trillion worth of options are tied to the stocks and indexes, and that's definitely going to add a wrinkle to the market today.
So well, first of all, how much had they cut the big 7 down to? They were over 50% of the NASDAQ 100. And who are the winners? Who's going to be gaining more weight in the NASDAQ 100?
So according to the methodology, yes, the big stocks, which means they're the ones who has a weighting of 4.5% and up, it's about 50, but now according to the methodology, it's going to be cut to 40. But if you think about it, that's still big. But then the stocks we're going to see to have their weight cuts are the Magnificent Seven, and those that are going to win, so to speak, although we're not sure if they're going to win in terms of performance, Broadcom, Adobe, Costco, PepsiCo, so those 4 are going to see the biggest boost.
Broadcom, Adobe, Pepsi, and
Costco.
And Costco,
4.
okay. Broadcom, Adobe, Pepsi, and Costco.
Yeah.
Okay, always good to know those names, because, trackers are going to have to add those as well.
Yes. And they're going to have to shed some of those Magnificent Seven, which is why volatility is going to be really high. And it's interesting because it's a summer lull. A lot of our colleagues are on vacation, but this is going to really probably jolt the markets back into life. We're seeing equities outflow for a while now, so maybe this will kind of revert any of those flows we're seeing.
All right, Isabel, thank you very much for that. Isabel Lee has been covering this in the run-up, and it's finally here, so now you know which stocks to take out or lighten their loads and which stocks to add. Let's get broader now, back to markets at large. Liz Ann Saunders is Chief Investment Strategist over at Charles Schwab. Great to have you on the program, Liz Ann. You've got, obviously, a fantastic vantage point at Schwab with so many trillions of dollars of assets over management, so many millions of customers trading stocks. What do you make of the run-up we've seen? Because 4550 on the S&P 500 is pretty heady, just over halfway through the year.
But maybe this is good news, but I don't sense the kind of froth among our retail clients that you might pick up if looking at broader metrics like AAII percentage of bulls or the put-call ratio. And that may be because a lot of the folks that I talk to of our clients on a day-to-day basis are either longer-term investors as opposed to retail day traders, or they represent advisors that are on our platform that are managing money for their clients. So it's not the kind of froth everywhere that in and of itself represents a risk for the market, but many of those traditional sentiment measures do show at best some complacence here, which all else equal could represent a risk.
What do you think of the obvious move here, or a knee-jerk reaction could be getting out of equities and into fixed income because you have such high yields? I was just talking about the 2-year, now back up to 484, which is pretty amazing. Does it make sense to you for clients to take less risk and get more return?
Well, first of all, it depends on who the client is, and with $8 trillion of client assets, it runs the gamut. And in fact, you specifically said, should clients get out of equities? I always like to say neither get in nor get out of any asset class is an investing strategy. All that is gambling on a moment in time or 2 moments in time if you think about the get in and get out. So the all or nothing decision making in any asset class I don't think makes any sense. And to try to cookie cutter in terms of allocation to equities, allocation to fixed income, doesn't make a lot of sense because it really runs the gamut in terms of risk tolerance. And I think we do try to simplify this too much, and that's not appropriate because investing should be a disciplined process over time. I will say, coming out of last year, there was this thought that, boy, both stocks and bonds got killed. 60-40 is dead. There's no benefit that accrues in terms of having fixed income exposure with your equity exposure. That got squashed, rightly so, because I think for most investors, having that diversification, not just in equities, but onto the fixed income side of things, in general, always makes sense.
I want to pick up on that point about froth and whether there's signs of it. You know, money-losing tech companies had become a bad word in 2023, but you look very recently, and the money-losing companies are the ones that are absolutely surging. Carvana, Rivian, on the smaller scale, you've got Joby Aviation. What does that tell you about, you know, our animal spirits starting to creep back into the market? I use Bitcoin sometimes as a measure of that. It's up 20% over the past month.
Animal spirits have to be here already. There's no creeping, right? They've run into the market.
I would fade, to use trader lingo, I would fade the move down the quality spectrum. I don't think this is the point in the economic cycle where you want to significantly sacrifice quality or profitability, to be more specific. There are times where you've got the potential for a big upturn in the economy. A perfect example of that was when, at the end of 2020, when we started to get the very positive vaccine news, and that really adjusted the trajectory in terms of the economy from continuing its recovery to really accelerating. And it made sense to go down the quality spectrum because that's often where the leverage is in terms of the balance sheet, in terms of what has been the lack of profitability and that leverage to an upward profitability cycle. I think it's premature to be making that bet. So I think you want to continue to lean into the quality factors and probably take some profits if you've seen outsized gains well down the quality spectrum.
I'm not much of a Twitterer, Liz Ann, but I was listening to Tom Keene the other day, and he referenced a tweet that you issued about multi-family units under construction climbing to 994,000 in June, tied for an all-time high that was reached back in May of 1973. The economic situation in this country still seems very strong when you look at labor, when you look at housing starts, as construction costs come down. We're starting to build more and more because there's no existing home sales out there. Do you think we're set up for a soft landing? Are you worried that the Fed is going to have to raise more?
Well, first of all, I think the debate on recession versus soft landing misses the nuances of the fact that we've really had a rolling recession because areas like housing, but also manufacturing, a lot of the goods-oriented categories, particularly consumer-oriented goods that were big beneficiaries of the lockdown phase of the pandemic, those have gone in recession. In the case of housing, we've actually seen some recovery out of what was a housing recession. But I also think within housing, there are lots of really different dynamics in terms of the supply-demand relationship. You already mentioned the massive supply that's been coming on the multifamily side. That's a potential risk factor. But even on the single-family side, you've got the big differential between new homes and existing. High mortgage rates keeping a lot of existing homeowners in their homes, elevating demand for new homes, which are in short supply. So you almost have to think of it in three different buckets. There's the multifamily, and then within single-family, there's the new and existing. And I think you're going to see divergence in terms of the metrics associated with each of those three categories. But the housing recession may be over. I just think the best case scenario for the broader economy would be better thought of as a continuation of the roll. Maybe you now have rolling recoveries and you don't ultimately get an NBER declared recession, but to say soft landing, everything lands softly, we've had hard landings in many of those segments already.
How do you put that into a portfolio vision right now? It seems like investors have to think about the Magnificent Seven and then everything else. And everything else is not as expensive as the headline would suggest. Is that appetizing to you?
Yeah, we have been saying that I think for a sustainability of this rally here, you want to see a broadening out. Maybe the best case scenario, particularly in terms of the sentiment environment, would be a bit of a convergence where you continue to see better participation down the cap spectrum in areas other than kind of techie or the grade 8, Magnificent 8, Magnificent 7, whatever category you want to talk about, but a bit of a pullback up the cap spectrum that might go a long way in easing some of the frothy sentiment conditions. So, if I had a magic wand and could divine what the market was going to do, that's what I think makes sense. But it all goes back to what we already talked about, which is stay up in quality. We've been very factor focused, not sector focused. This is not the kind of environment where you want to make monolithic sector calls. There is high dispersion. There's low correlation. That gives you an opportunity to screen for things like strong earnings revisions, earnings surprises, some of the value-oriented factors like strength of balance sheets, self-funding companies that are able to maintain profit margins, and focus on looking for opportunities with that factor-based approach as opposed to trying to do it with a monolithic sector or style-based approach.
Lizanne, always great to get some time with you. Appreciate the nuanced view of these markets. Very important grounding for us. Lizanne Saunders there from Charles Schwab. I just want to quickly mention a story coming across the wire from Bloomberg News. Jack Farshi wrote the story. He who co-authored The World for Sale with Javier Blas. It's about Vitol Group, Amber, the oil trading house or the energy trading house. Because of a windfall year last year, $15 billion in profits, Vitol has doubled the pay of its employees. On average, each employee at Vitol, and they have 3,311 employees, is going to take home $785,000 in salary and bonuses. That compares with $349,000 last year. So it's going to be a very happy year for employees of Vitol. And by the way, that doesn't even take into account stock payouts to the roughly 450 top executives. So big payout for Vitol. Coming up, AutoNation had a strong second quarter, but the shares are down by the most since last September. We'll tell you why when we come back. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Markets. I'm Amber Canwar with Matt Miller. Time now for Stock of the Hour. AutoNation is down by the most since last September following earnings. Margin pressure from falling car prices are overshadowing the company's strong quarterly results. Now, the company does not expect margins to return to pre-pandemic levels for the foreseeable future, Matt.
Yeah, it is a very interesting time. We're expecting to see those margins get compressed, not to pre-pandemic levels, but obviously as monthly payments rise, you've got to do something to get those cars off the lot. And as more and more cars are coming off the lot, or on the lot, I should say, that pressure increases. Let's bring in Keith Naughton right now. He covers the auto industry for us out of Detroit. Keith, very interesting story here. And we now have two dealers in AutoNation and Carvana, who both say, or their executives, top executives say, they expect prices to continue coming down, I guess what, on both new and used vehicles?
That's exactly right, Matt. Both sides of the aisle, new and used, are both coming down. In the case of AutoNation, you know, they had an EPS beat, they had a revenue beat, and their new car sales actually finally were up. But gross profit per vehicle fell by 25%, because what's happening is as the inventory gets replenished, the automakers are returning to discounts in order to move the metal. So it's back to sort of the old ways, and that's taking a big hit on margins.
This is very interesting. You know, car sales are one thing. Another stock that we've been tracking is Harley-Davidson, which got an upgrade from D.A. Davidson. I don't think there's any relation there, but it certainly does seem to be that there might be a little bit of momentum on this name, which has struggled.
Yeah, I mean, there were very low expectations for Harley going into its earnings next week on July 27th, but the Davidson analyst said that he had done dealer checks and demand is higher than they thought. They have some new high-tech models coming out, and the pre-orders look very good. So he sees an upside surprise in earnings.
All right, Keith, thanks so much for joining us with that perspective. That's Keith Naughton joining us. Here's what we've got coming up next. American Express shares are trading lower after earnings reported. We'll tell you why when we come back.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Markets. I'm Amber Canmore with Matt Miller. Now for today's For What It's Worth. Shares of American Express are lower today after second quarter earnings. Now, volume on Amex's network increased 8%. That's the weakest gain since the first quarter of 2021 and a smaller increase than analysts were expecting. But travel and entertainment spending jumped another 14% in the quarter, Matt.
Yeah, so they're difficult comps, right? Because at the same time last year, we were doing revenge travel, going to restaurants as much as we possibly could, and basically depleting all of our excess savings. Now that we're done with that, we're going to actually have to put money on the card without paying it off every month. Jenny Serrane joins us now. She covers banks for Bloomberg and covers this Amex story as well. So they did see an increase to a record in terms of volumes, but it just wasn't a good enough record for investors.
Yes, that's exactly right. So I think, folks were just not expecting things to slow down quite as much as they have. And so you're just seeing a return to normal much faster than what analysts were anticipating. But you're exactly right. These are really tough comparisons for Amex to go up against a year ago when exactly we were all doing our revenge travel, getting back out on the road. And now things are just a little bit more of a normal summer for Amex.
One of the insights into where consumers are spending is restaurants are still pretty robust and, in fact, coming ahead of other, revenge-type sectors like hotel and travel.
Yeah, I thought that was a really interesting stat that they shared this morning that, within travel and entertainment, restaurants are now the biggest category in terms of spend. So that's surpassing airlines, that's surpassing hotels. And what CFO Jeff Campbell told me was this is really because, during the pandemic, we all got used to ordering out and doing our Seamless and DoorDash and Grubhub, and that hasn't changed. So even though we've returned to in-person dining, we're still doing a lot more of this online ordering, and so that's really helped boost this entire category. And yeah, consumers are spending more on that than they spend on flights and hotels, which is pretty insane.
The company has also cut expenses even deeper, so earnings per share rose to higher than the street anticipated, and they kept their full-year forecast, which is good, right, in terms of profit.
Yeah, that's exactly right. So they've really got got an eye on expenses, especially their marketing spend is going into the back half of the year. And so everything, it's funny because the company was really pointing to just how strong of a quarter this was, a record on lots of different fronts, really just continuing the kind of growth strategy that they've had, but just wasn't as strong as what analysts were expecting coming into the day.
What did we see on charge-offs?
I think we're seeing a lot more of just Amex doing exactly what Amex does. They're known for their platinum cards, and they're known for just the real big influence or focus on millennials and Gen Z. And so I think we're just still seeing a lot more of that focus here.
All right, Jenny, thanks so much for joining us. Jenny Serene there covers the financials for us, and we're talking about the reason Amex is down, even though it beat on the bottom line. I also want to mention a stock that's rising right now, Disney, up after a CNBC report that Disney's ESPN has held early talks with the NFL and the NBA to become minority investors in the network. I think it's very interesting and would love to see how they want to structure this. As we say, CNBC is reporting this. They cite unidentified people familiar with the matter, and they say that they are early talks or in early stages. It isn't, nothing's been decided yet, but the Disney CEO is involved, Bob Iger, according to CNBC, as well as the head of ESPN, Jimmy Pitaro, and they are holding talks with at least those two leagues about becoming minority investors in the network. So that would be a very interesting workout.
Especially because Iger certainly has said, maybe parts of the TV business are non-core. Everybody seemed to say, well, except obviously ESPN. It's interesting that this could be one of the first assets here to be monetized in TV.
We'll continue to follow this story for you. For Amber Kanwar, I'm Matt Miller. This is Bloomberg.
In climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg TV and radio.
The Dow gets ready to make it 10 in a row. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. About 2 hours to go. We're looking at a modest gain on the S&P 500, up about 0.4%. You can see the NASDAQ 100 bouncing back from its beating yesterday, up about 0.4% right now. Remember, it fell 2.3% yesterday, so it's a pretty big hole to climb out of. If you take a look at the bond market, really not much going on here. The 2-year Treasury yield barely up at all, of course, as we await next week's central bank palooza, whatever you want to call it. We know that the BOJ, in addition to the Fed, is expected to take the stage. There was some reporting out overnight that the BOJ said to see little need to tweak its yield curve control policy. You can see that the yen really taking a beating as a result. U.S. dollar versus the yen right now rising as the yen softens, Scarlett.
And there are two major catalysts for some last-minute positioning here before the end of trading today. You have the special rebalancing of the NASDAQ 100 index to reduce the influence of big tech names like Microsoft, like Apple, like NVIDIA. That's going to take place after today's close. At the same time that $2.4 trillion of options contracts tied to stocks and indexes mature today. Now, combined, these two events could boost volume and increase volatility towards the close of trading. Now, speaking of twin events, it's Barbenheimer weekend. We've got the long-awaited big screen releases of Barbie, which is based on Mattel's toy doll, and Oppenheimer, which is about the father of the atomic bomb. Who will prevail, or will moviegoers escape the heat to watch both in a double billing? Either way, Hollywood is hoping the films save the summer box office as labor strikes stretch on. And Katie, looking ahead to next week, you talked about how there's going to be a central bank palooza with the Fed leading the way. Bill Gross is already talking down the U.S. Treasury market. The one-time bond king says that 10-year yields will stay above 3.5% for a long, long time. He actually said long, long time, in large part because of pressure from the federal deficit and also the Fed's efforts to shrink its balance sheets.
And in some ways, that call hinges on what we get next week. We've got the Fed, we've got the ECB, we've got the BOJ. So let's look at where global policy rates stand right now. You have the Fed up in the lead there, 5.25% on their upper bound in white there. And you can see the ECB, it's in blue, it's basically mid-path. They stand at about 3.5% right now. Down there at the bottom, you have the BOJ. They stand alone in many ways, and they still have negative rates, again, down there in purple, expected to continue to flatline for a while here, but definitely one to watch with the BOJ under new leadership. But let's focus on the Fed and what the market's actually pricing in, because it feels like for once maybe the markets and the Fed are on the same page. You have 33 basis points left of hiking priced in. We know that next week is pretty much baked in the cake, at least when it comes to what we're hearing from policymakers and the market. And Powell has been pretty clear that he doesn't see rate cuts for a while. You can see that right now we only have about 5 basis points of cuts priced in. So Scarlett, at least for the time being, maybe some harmony here.
Some harmony. We'll see how long that lasts. Let's bring in Bob Elliott now, CIO over at Unlimited Funds, to give us some more perspective here. Do you agree that bonds, the bond market, the stock market, and the Fed are all kind of on the same page?
Well, I think for right now, in the short term, they're all pretty much on the same page, which is that the Fed...
Wait, short term being next week.
The short term certainly being next week, maybe for a few months. I think the real question is there enough softening of inflation and enough loosening of the labor market to let the Fed take a more meaningful or longer term pause? And I think really where the disagreement comes is as we turn to 2024, we still got those 5 cuts priced in to 2024. Hard to see the sort of economic outcomes priced into the equity market happen if you're also going to get 5 cuts in 24.
Right. And a lot of economists have started to revise higher their forecasts for GDP as well. So if we're going to see a bit of an economic, I don't want to say reacceleration, but firming, is that going to lead to a pickup in inflation at some point?
Well, I think you are actually seeing some interesting signs of reacceleration in some of those key cyclical sectors. What you see in the housing market is a bit of an uptick. You see a bit of improving sentiment in the manufacturing space as well. And those are indications that the Fed and policy continues to be a step or two behind what's going on with the real economy. And in that circumstance, that's actually a pretty good time for equity markets. And that's really what we've seen. If you look at what's going on with the price action, stocks are up, bonds are basically flat to sold off a little bit. That's all aligned with better than expected nominal growth. And right now, the momentum looks pretty strong for that to continue.
Let's talk about the bond portion of what you just said, because of course, as Scarlett mentioned, we did get that Bill Gross call earlier today saying that basically a bond bull market not in the cards, and that 10-year yield's probably above 3.5% for a long time. His words, not mine. Currently, we're at 3.82%. Where do you fall?
Well, I think the main question is what's the ordering of how things have to play out. Right now, we're continuing to get enough asset price acceleration, enough stock market strength. It's keeping the overall economy buoyant and keeping those inflation pressures in the system over time, the tight labor market and the positive economic conditions. And so the real question is what's the ordering? First, you have to have the bond yields rise, and then the bond yields rising will start to hit stocks, and that'll start to create a cooling of the economy. And so I think one of the things that Bill Gross is pointing to is the fact that first we have to go up before we can go down in the bond market.
So stocks aren't the economy, but it sounds like what you're saying is that the financial markets definitely have an influence on the economy.
Well, we're back to talking about financial conditions, right?
Yeah.
Like was hot earlier this year. Stocks certainly have an influence on what's going on with households' demand, savings rates, as well as business interest in investing over time. And so you see pretty decent earnings. You see a relatively buoyant stock market. That's typically not the sort of set of conditions that would align with a cooling labor market or job losses. And without those job losses, labor markets stay tight, and we continue to have that relatively strong nominal growth that's pushing inflation higher.
Decent earnings so far, but we haven't really hit the heart of earnings season. And next week, you get about a third of the S&P 500, making up, I believe, 40% of the index's market cap reporting. What are you going to be looking for to validate your view of the economy?
Well, I think there's two different points. First, earnings release is very important in terms of getting a lens into those financials, and particularly those financials that looked at risk following SVB. So far, what we're seeing is that the regional banking system looks pretty good, all things considered. Continue to have okay NIMs, credit losses are relatively modest, and you're seeing that deposit flow come back into the system. So that's sort of the core area. There was a question about whether that would spark a broader problem. Now, as we look at the broader economy, I think the main question is, what does that pressure look like around pricing power on the top line versus margin compression? Those are the two pressures in the economy for many of the sort of non-financial sectors of the economy. And are we seeing companies continue to basically be able to increase their top line, which shows that inflation pressures are still in the system? So far, it looks pretty good that companies are able to hold that top line, even if the margins are coming down a little bit.
And as we head into earnings seasons, I love to get cross-asset here, because it's really remarkable that even as we talk about all the big reporters to come, you look at the VIX right now, it's below 14. It feels like this market has been pretty calm. You take a look at credit spreads, they've really been trading sideways. And then you look at the Treasury market, and Treasury market has kind of been a problem child in terms of the volatility. What does it say that it's the bond market, specifically the Treasury market, that seems the standout volatility this year?
Well, I think the real question is a lot of wrestling with what is necessary for the Fed to do to accomplish its goals. And I think we've seen real swings in expectations, everything from higher for longer before SVP to what looked like a deflationary depression right after SVP, and now we're back to the higher for longer story, and recognizing that, whereas I think in many ways stocks got the picture right, that we're having high nominal growth and nothing looks to be really standing in the way of that. The bond market has been a bit all over the place in terms of figuring out what's likely to transpire, and so that's really why we've seen the volatility.
Yeah, a lot of people calling treasuries the new meme stocks with the way they're moving. Bob, thank you so much for joining us. Bob Elliott is CIO over at Unlimited Funds, and of course, Bob Elliott mentioned one key thing to watch for is the financials earnings. So coming up, we're going to get you up to date on the latest regional bank earnings, including Regions Financial and Comerica.
Plus, we got a lackluster outlook from American Airlines that's tempering investor enthusiasm over the boom in air travel that lifted U.S. carriers earlier this year. We'll discuss with a Raymond James analyst.
And we'll look at the growing risk posed to commodities by the scorching heat wave that's affecting much of planet Earth. All that and more coming up. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Well, shares of Regions Financial and Comerica both higher today after they reported jumps in net interest income, despite concerns, of course, about credit contractions. Sally Bakewell, who leads Bloomberg's U.S. bank coverage, joins us now. And Sally, it feels like we're through the bulk of the regionals reporting earnings season, if you will. And it feels like some of those worst case scenarios, those fears, haven't really materialized.
I think that's right. I think we've gone through this very dramatic period of sort of intense and swift bank runs, which led to the collapse of a few. But I think now we're entering this new phase where the pain is still there, but it's a slower burning pain. So what we really saw with the regional bank earnings this time was that while some of them actually managed to rebuild deposits, they are having to pay up a huge amount more for deposits via interest expense. Now, in fact, the bigger banks are not immune to that either. JP Morgan and Wells Fargo saw interest expense rise a whopping 465% each, but they can handle it better. For the smaller banks, this will really eat into their profits.
Right, they don't have anything else to lean on aside from what's happening to their core business. So there are some of the regional banks have been selling off assets to kind of shore up their balance sheets. What are you hearing from the bank executives on how far along the process they are there?
I think they have made a lot of progress. So we heard, for example, with Western Alliance, Truist, and Citizens, as well as KeyCorp, they're all making these kind of strategic targeted asset sales. You know, they're selling student loans or they're selling commercial real estate debt in sort of efforts to kind of shrink their balance sheet to make them sort of more able to weather these higher deposit costs. So next week we have a few more regional banks reporting. We have PacWest, which has been very notable throughout the regional bank crisis because it took steps to do exactly that, sell assets, and it said it was reviewing strategic alternatives. So it will be very interesting to see what more they have done, if anything.
Well, yeah, that's what I want to talk about. PacWest, of course. We're not completely out of the woods yet. What will you be listening for, and what's Wall Street expecting when it comes to this name?
I think they probably expect more of the same. This sort of dramatic, intense deposit flight has probably decelerated a lot, but the question will be how significant are the deposit costs that it's having to pay? Because, of course, depositors have wised up to the fact that interest rates are very high and they're not getting a cut of it. And so to keep depositors, banks are having to pay up to stop them from going to CDs or money market funds. But obviously that is costing the smaller banks dear.
Yeah, paying up is really the theme for the regional banks and the big banks, as you say, this past quarter, and will continue to be for a while. Sally, thank you so much. Sally Bakewell leads our coverage of finance here in the U.S. Now, some of the economic forecasters who were pretty much out front in predicting a U.S. recession, they're now starting to hedge their bets as inflation wanes and the economy's resiliency holds out. Bloomberg's Rich Miller joins us now with the story. Rich, give us an example of someone who was calling for a recession and is now, maybe dialing back those expectations.
Well, probably one of the first ones out of the box was Deutsche Bank. Peter Hooper, who's been around a long time. He was a 25-year veteran at the Fed. He was one of the first ones out of the box to call for a recession. Now he's basically saying it's a toss-up. He's still in the recession camp, but it's just a little above 50 as opposed to 75, 80%. And there's other folks who Doug Duncan at Fannie Mae was another person who was early on to call a recession, and he's also calling it a toss-up. So there has been some rethinking going on.
It's interesting to hear that because you think about what's happening in the stock market, for example. A lot of the strategists have had to revise up their S&P 500 targets. But, Rich, is there anyone saying, are there any economists out there saying that actually this is it, we're watching a soft landing happen right now?
Yeah, I mean, there are a number, and they've been basically saying that for a while. I mean, we had a survey out today, and 60%, the economists see a 60% chance of a recession. So, there's a fair portion who see us avoiding a recession and getting but the majority view seems to be now that we will have a recession, but it's 60% is not 80 or 90%.
No, it's definitely an improvement. I wonder, as we see people like Peter Hooper and others who are perhaps bearish turn a little bit less bearish, are there those who may have been holding out saying, yeah, we'll see a soft landing, who are saying a little bit, leaning more towards the camp of, the economic slowdown may be a little bit worse than what we had thought would happen the same time last year?
Not that I'm aware of. I mean, the numbers have been going the other way, right? I mean, as you mentioned, we've got 500 basis points of Fed rate increases, and yet the housing market is rebounding, right? We've got at the same time, though, that the economy is holding out, inflation's coming down. We've got this consumer price index has fallen from 9% to 3%. So, it's, what do you say? Don't fight the tape, right? I mean, that's what you're seeing here.
Rich, let's talk a little bit more about the Fed. As people have to sort of revise their recession calls here, maybe push them out, is that being paired with some of these economists pushing out their Fed rate cut expectations as well?
Yeah, I mean, I think generally that the Fed's message, which was kind of higher for longer, has been taken on board. I think, the markets were perhaps more skeptical of that than the economists, but the economists have come around to that as well, and that they see that the Fed is actually pretty intent on getting inflation down to 2%. And is willing to keep the rates high to do that.
All right, Rich Miller, great reporting. Really appreciate it. On, of course, those recession calls as we head into next week's Fed meeting. Coming up on this program, we're going to talk about American Express. Shares are lower today after earnings. We're going to break down how people are getting more selective with their spending. This is Bloomberg.
of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Season is here.
Decent start to earnings season. We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Shares of American Express falling as much as 5.5% today after revenue rose less than expected. It turns out spending growth on the firm's cards slowed to the lowest in more than 2 years. Amex's CFO saying spending levels are, quote, more stable now following the post-pandemic boom. Joining us now is Bloomberg's Jenny Serene. And Jenny, in the 90s, Amex had this tagline that was, don't leave home without it. It feels like Amex has increasingly become this proxy for Americans spending when they go traveling all the time.
Yeah, no, I mean, that's exactly right. And definitely they're most closely associated with travel and entertainment and kind of that premium experience that consumers have really flocked towards in recent years. And it's a funny day today because, you know, spending on their network was at a record. It's just slowed in terms of the growth that they've put up. And so it's this weird mix of, you know, things are looking very strong, just not as strong as what folks wanted.
Well, going through these results, that is exactly what I was wondering. How much of this is just tough comps?
Yeah, no, I think that's exactly right. So you had a year ago when we were all suddenly freed from all the pandemic era border restrictions. It was the rise of revenge travel that everybody liked to talk about. And so, you know, now you're just kind of lapping those really tough comparisons. And even, you know, in the first quarter, it was a year ago from the first quarter was Omicron, and we were all kind of stuck back at home. And so when you look at these growth levels really dropping as much as they have, it's not so much a concern as it is us getting back to kind of normal life post-pandemic.
So let's bring in some comments that Steve Squeri, the CEO of American Express, told us. He said, to your point, record revenue, record EPS, record billings. The growth plan still stands. We're firing on all cylinders here. And it's, to your point, it's perhaps analysts and investors got a little bit ahead of themselves. My question is, going forward, because everyone's so excited about the efficiency, probabilities, and prospects of AI, what does Amex say about how it's going to incorporate AI into how it does business?
Yeah, you know, it's interesting. I think generative AI will bring a whole new kind of front to this conversation, but they've already been using artificial intelligence for a really long time in their underwriting and their marketing. So I think this will make them more efficient, to your point, but it won't be a totally new area for them because they've had to rely on some of these newer technologies for making credit decisions and who even to market their cards to. So it'll definitely be a new, interesting front in that, though.
I want to talk about the competitive landscape here, if you will. What we heard from Amex today, how does that compare to a Discover, for example?
So they're a little bit of a different company. They have this very big focus on the prime spenders, whereas Discover likes to focus on the prime revolvers. So you've got two different strategies. One is really relying on interest income, and one is really relying on the fees that they collect from merchants every time you go out and swipe your card. And so I think you're going to see a bigger divergence, especially as interest rates are rising. You know, that obviously benefits interest income, and it's happening as they try to tamp down inflation, which hurts spending. But Amex Amex has really proven that folks are still willing to spend and get out there and travel and dine out. And so it's definitely an interesting divergence that you're seeing because it's two prime-focused issuers, but slightly different strategies.
I remember the days when Amex wasn't even a credit card. It was a charge card because you paid your balance in full. It's kind of lost some of its market share in terms of being the premier card, hasn't it? I mean, you've got Chase, you've got other cards that have come in and taken some of the thunder.
You know, it's what they like to say about that, and it is an interesting point. They think that this big increase in competition that they've seen